which they get a lot of grief about, but actually losses there are declining. They're down about 10% over the last 12 months, down to about $1 billion a quarter. For Reality Labs, it's going in the opposite direction. So you now have about $4 billion of quarterly losses on average over the last 4 quarters, and that's likely to accelerate. But certainly, if they remove those, 15, 20 billion of losses, that changes the cash flow outlook for the company.
Stefan, Meta has 63 buys, 7 holds, and 3 sell ratings. You among those 3 sell ratings. How difficult is it as an analyst to put a sell rating on a company that a lot of people have a lot of love for?
Yeah, thanks, Lisa, for asking that question, because it's not easy, to be honest. We aren't underperformed, so I think that's important to say. I think for all of these companies, they are great companies, and Meta is another great company. But as you just discussed with Apple, as we've seen with other tech stocks, there are times to own them, times not to own them. And for some of these companies that go through massive investment phases, thinking specifically of Amazon and Meta, typically you haven't wanted to own them during those periods of investment, and you have wanted to own them during those periods of harvesting. We've seen that with Meta over the last couple of years. The stock's up 400%. Obviously, we've seen that with Amazon as well. It now looks like both companies, to a certain extent, are moving back into that investment phase. And the market right now thinks that's okay. They've learned from the past. It's different this time. They're going to thread that needle and sort of manage the efficiency side of the equation, as well as driving those investments for future growth.
Stefan, there's a sort of theme that people have been talking about where spending can be good. A CapEx spending boom can be the appropriate thing to do if it's on the right types of operations. Are you pushing back on that and saying, just in general, during investment cycles, they're not going to have the cash to give it back to you, so probably going to underperform?
I would say a bit of both. Absolutely investing is good. And I think the Gen AI investments, the AI investments are good. We're seeing those core AI investments already paying off for Meta through improved recommendation engines and content for users, through ad targeting and measurement for advertisers. And I think Gen AI is the right way to go in terms of investments. But again, the monetization mechanism is not very clear just yet. It will take more time. I think on Reality Labs, what the market would like to see is the company say, we still believe in it, but we think it will take more time to play out than we originally anticipated. So we're going to move some of that spending more over towards AI, and that's where we have some of the concerns near term.
Well, you prefer Gen AI then. What company do you think is doing it well if you don't like Meta?
Yeah, and again, it's not a question of not liking Meta. It's just thinking that they have further to spend to catch up, right? When you look at the proprietary silicon that they're now developing for model training and inference, this is something Google's been doing for 7 years with their TPUs. It's something that AWS has been doing for years as well. Amazon will have their Trainium 2 chip available in the second half of this year, which is probably going to be driving more consumption of Amazon Web Services platform. So there is more investment to come here. And when you look at Google, for example, it's actually trading at a discount to Meta right now on an EV to EBIT basis. One of the reasons these stocks have traded on discounts is because they've been perceived to be kind of one-trick ponies, just advertising. But we're seeing with Google already 25% of sales from subscriptions, from consumption, 100 million subscribers for YouTube premium services, 100 million subscribers for Google One, 8 million subscribers for YouTube TV. Obviously, a Google Cloud business, which is really now gaining recognition with enterprises, still trading on a discount. We think as they continue to diversify their revenue streams, they'll see the valuation with Meta flip. So we think Meta could go up to a 5% free cash flow yield, with Google falling to a 4% free cash flow yield.
Stefan, just to wrap things up, it is Payrolls Friday. We're looking ahead to this number and trying to get a read on the US consumer as well. Most of the major companies in your coverage have reported earnings. I just want to understand from your perspective what state this economy is in right now, whether you can strip out the more secular structural growth themes and focus on the cycle for a moment. What kind of strength do you see?
Yeah, so we just published yesterday our BNP Paribas Global Cloud Scanner survey of 100 software buyers. And the way we characterize it is things are rolling along the bottom. So things aren't getting worse. They're not really getting better in terms of enterprise technology spend. Slightly better in the US and slightly better with large enterprise, slightly more cautious in Europe and slightly more cautious with small businesses. On the consumer front, it's okay. It's not great, right? I mean, Amazon said the same thing. last week. We did just upgrade Shopify yesterday. We think their results will be good next week, good enough to see some revenue growth acceleration. But to your point, a lot of these secular growth trends continue to power through. What's exciting with some of these big tech companies is it's not about Gen AI yet. The numbers they're delivering today are from the core businesses, which remain quite healthy. Gen AI is still to come, and those valuations still seem reasonable, considering they're not yet factoring in a lot of that contribution that's still to come.
Stefan, this was great. Let's do it again soon. Stefan Slowinski there of BNP Paribas. The latest on Meta, a rare underperform, a rare sell on that stock.
I liked your question there about what have we learned. And he said, we're rolling along the bottom.
Yeah.
That indicates a very different picture than a lot of what we're hearing in terms of optimism and boom times and late cycle. Rolling along the bottom would indicate more of an early cycle, right? Because essentially you only have up to go. That's a very interesting take.
Meta right now, negative by about 0.25%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A second Boeing whistleblower has died. A former quality auditor at a Boeing supplier, Spirit AeroSystems, died just 2 weeks after developing breathing problems, that according to the Seattle Times. The employee had raised concerns about the safety of the 737 jet. In March, another Boeing whistleblower reportedly died from a self-inflicted wound. Now, the drama is still continuing in the bid for Paramount Global. This time, it's Apollo and Sony making an offer, $26 billion, all cash. Sources tell us it's described as a non-binding expression of interest. Now, Paramount has been in exclusive talks with David Ellison-owned Skydance Media, but a number of shareholders protested that offer, saying it gave controlling shareholder Sherry Redstone a sweetheart deal. That period of exclusivity is scheduled to end today. Ferrari is using this weekend's Miami Grand Prix as an opportunity to unveil a new sports car. It boasts a top speed of more than 200 miles per hour. The 12 Cilindri will cost more than $400,000, and it's inspired by Ferrari's touring cars of the 60s. Deliveries will begin by the end of this year. And John, if I may, if they want a viral marketing moment, just have Lewis Hamilton show up in that thing this weekend. That's
Beautiful.
your brief.
I'm not sure you can do it yet.
I don't think so.
When he can, those things are going to sell. Danny, thank you. We accept gifts. We don't accept gifts, I'm told. Okay, we don't accept gifts. Just in case anyone was interested, send me one.
Oh, really?
So, yeah, you know.
You would just sort of be like,
just a cheeky 400K, Bramo. What's that between friends?
They could send it for a quick test drive, but then you have to give it back.
Sort of a test drive, a permanent test drive.
Yeah, I was about to say a test drive.
An open-ended test drive.
The test drive.
An open-ended test drive. We accept gifts. We don't.
We don't.
Up next, counting down to the payrolls report.
If you were to see a big move lower in terms of the payrolls, then that would really shift, I think, the overall thinking in the jobs market and potential summer rate cut back in play.
You don't think they'd allow just sort of a Ferrari, just a sort of cheeky Ferrari, just as an exception to the rule?
I suspect that you're going to get a little toy Ferrari car.
I used to love those as a kid.
Well, you might get one.
Okay, looking forward to the Grand Prix this weekend. We accept tickets. No,
we don't.
We don't, all right.
Stop.
The Federal Reserve countdown is behind us. The payrolls countdown continues, 45 minutes away. The number, 240K.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Just to reiterate, we do not accept gifts, okay? We cleared that up. All right, good.
We may not have gotten in trouble.
Trouble with management over something like that. Come on, jokes. Going into the weekend. Get a grip. Equity futures right now on the S&P, positive by 1/3%. Yield to lower by 2 basis points on a 10-year, 455.89, and the FX market 107.46. I sense I didn't make that better. Under surveillance this morning, counting down to the payrolls report.
It's been hard to say that the jobs market really is weakening. And so I think if you were to see a big move lower in terms of the payrolls, then that would really shift, I think, the overall thinking in the jobs market and potentially keep it where, or at least put a potential summer rate cut back in play. But it'd take more than just a weak April number.
It's the latest this morning, less than 1 hour away from the April payrolls report. Sarah Wolf and the team at Morgan Stanley expecting a gain of 250,000 jobs in consensus with Wells Fargo, JP Morgan and Bank of America. Sarah saying, quote, "We expect continued strength in April. The pace slows slightly from recent months. Our forecast is likely consistent with marginal slacking in the labour market." Sarah's with us around the table. Sarah, good morning to you.
Good morning.
This from the team over at Citi, sensitive to the downside. I wonder if you agree with this line. After Powell took hikes off the table at this week's FOMC meeting, downside risk to yields are magnified by downside risk in today's jobs report. Are we sensitive to the downside this morning?
I do agree with that. I think Chair Powell has been basically dismissing stronger job gains because we don't really know how many jobs we could be adding to the economy without it being inflationary. So there is more sensitivity to downside. And when Chair Powell laid out the two paths for policy, it's higher for longer or cuts, and what could drive more aggressive cuts is a faster deterioration in the labor market. So the onus is on the labor market for more cuts.
What's the source of that downside, do you believe? Based on all the information we have in front of us right now, what could the possible source of downside today be?
It's really hard to see meaningful deterioration. One of the things that we saw that drove upside in the first quarter was some of the warmer weather. So we got stronger construction jobs. We got stronger retail, which is a little bit of a big question because retail sales have not been very strong. So we could get quite a bit of payback there, and that could shave off about 50,000 together if we get some more downside on just those two components.
How do you understand the rhetoric that we hear from companies, which is a lot less optimistic, a lot less rosy than what we're hearing from some of these headline numbers or inferring? How do you understand that discrepancy?
I think we're seeing pockets of the consumer that are deteriorating quite a bit in where they're spending, but the overall picture is still healthy. So what do I mean by that? Households are spending on services and not goods. We've been saying for a while that goods were going to be very weak, and that's retail. That's mostly captured in the companies in the stock market, whereas for the broader economy, we're a services economy. Almost 70% of consumer spending is on services. And so now we're seeing that both price and unit growth is under a lot of pressure for retail. People don't want to be spending on everything anymore. Interest rates are high, lending standards are very tight. The other thing is the lower income consumer, which we've been saying has been basically in a recession for over a year now. And we're seeing that come through in the company data where, for example, in the leisure space that, economy to mid-scale hotels are not doing as well, that for grocers, that people are now not dining out at McDonald's anymore and they're going back to grocery shopping. And so I think there's pockets that are doing better and others that are doing worse. But if you look at services spending in the first quarter, it was up 4% on the quarter. Extraordinarily strong.
So I'm listening to you and I'm trying to understand whether we can really bank on sort of the high-end consumer supporting the overall economy while there's essentially a recession at lower-end consumers, and then it can kind of come together, and this is kind of the bottom, right? I mean, that's sort of what we were just hearing from an analyst who covers the tech space. Is that how you see it, that we're kind of rolling along the bottom here with these sort of shifting sands, and we're going to come out the other side on an upswing?
So I think we are rolling through the bottom. The upside is going to come with the cuts, right? And when the cuts happen and how much they happen, because that's going to start to ease up the credit market. That's going to allow lower middle income households to start spending a bit more. It's also going to allow for more churn in the housing market. So more people are buying and selling homes. They're going to be spending more on their home. That stimulates the economy significantly. But the higher income household, the top 20% income distribution, they drive 40% of consumer spending. They really run the economy in a lot of ways. And so if they want to keep spending, maybe it's not on goods, but if they continue to spend at a solid pace, that is enough for us to chug along without a recession.
If the data doesn't come in time to give Powell the confidence enough to cut, but you say the lower end consumer is already in a recession, how much damage is it to this economy and to those individuals if this is prolonged?
It's tricky, right? Because Powell has to react on the aggregate data. So overall GDP numbers are strong, overall payrolls are strong, but the lower end consumer has been under a lot of pressure for a lot of reasons, right? We've been talking about why the aggregate consumer was going to fare better in this hiking cycle than in previous ones. And the biggest one, fixed rate debt. 90% of household debt is locked in at a fixed rate. That is not the reality if you are not a homeowner, where half of their debt is revolving rate. The other one is that if you look at almost like the household NIM, it's better in this cycle than in previous cycles because of the big savings buffer that households built up. So that ratio of debt to savings is a lot lower, but it's for the households that saved. Also, as we know, the middle higher income households, they are sitting on a lot of savings. And so Powell's in a conundrum, right, where the best thing that he could do is keep a strong labor market so that real wages go up, because that's really what matters the most for the lowest income household. And we are seeing that. I mean, we have a long way to go on real wage levels for low income households, but we're on the recovery.
Let's talk about the labor market and the upswing we've seen in immigration. How do you think about this?
Sure. So, I mean, immigration basically just means the economy is bigger, near-term potential labor force growth is stronger, near-term potential GDP is stronger as well. We've estimated that break-even payrolls, the amount of jobs that you could add to the economy without it moving the unemployment rate, 265,000. Because of how strong immigration growth is. I mean, it's massively high. What does that mean? It means that if we get a one handle on payrolls, we should start to think that that's actually possibly a weak print, which is crazy when we used to think break-evens were 100 to 150,000.
Is this getting harder and harder to understand?
It's always getting harder, yeah.
Post-pandemic, we've just seen these massive numbers, and I remember the estimates. I'd say the low is like 200K, 150, and the high was like 500. It was literally like throwing darts with a blindfold on. And I just wonder what it is now. How easy is it to understand what's happening in this economy?
It's tricky, right? Because the immigration flows were happening last year, but we didn't really figure out that it happened until 2 months ago when the CBO came out with these estimates. So we've basically been reading the economy wrong in 2023, and now we have a better sense. The thing that I worry about is while we are getting a lot of immigration growth and it is helping support jobs and overall GDP, what about skill frictions, geographical frictions? There's not every industry is hiring. Typically, you see immigrants work in agriculture, they work in construction. Those are not the hot industries right now. We're really seeing more hiring in food services and leisure and hospitality. So you really need to make sure that where the labor supply is coming matches the labor demand. And that's going to be the big question for how high the unemployment rate goes this year.
How fragile is the sort of parameters that you laid out of a soft landing? How fragile is this idea that the high-end consumer can keep spending, even as a low-income consumer is kind of flat on their back?
At this point, it's very hard for me to see, given everything we know, a hard landing scenario playing out anytime soon. I think the hard landing scenario could come maybe in 2025 if the Fed has kept rates too high for too long and they react too late. And what could come with that if core services are stickier, if we start to see new rents start to reaccelerate and that starts to worry the Fed, and then you get to a scenario where they've just waited too long. And Chair Powell said it himself, the lags are longer than they thought. So we might be getting a big impact later this year and into 2025. And so there's still this risk management approach where, the FOMC does have to cut to stimulate the economy at some point. I think where we are right now, the recession risks are still fairly low, though.
Things are complex. They always are, but they are super complex right now. Sarah Wolf of Morgan Stanley. The team at Morgan Stanley looking for 250 at 8:30 Eastern Time. The median estimate in our survey, 240,000. Coming up shortly, Nadia Lovell of UBS, former Fed Governor Randy Krosner, Jeff Rosenberg of BlackRock, and the brilliant Mohammed Al-Erin of Queen's College, Cambridge. That is your third hour of Bloomberg Surveillance. Bramo just around the corner.
Yeah, well, this is the reason why I don't believe in midlife crises. They're rolling crises. They're rolling recessions. It's similar.
Who's this a message to today?
It's just general.
Okay, all right. From New York, this is Bloomberg.
We're
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Right now, I think the labor market's holding up fairly well. You're going to see the labor market showing us an easing of tightness.
We need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market.
The labor market is also getting into better balance in terms of supply and demand.
We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It is Payrolls Friday, and the Payrolls Report is 30 minutes away. The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Your lineup for the next 60 minutes, this is what it looks like. We'll catch up with Nadia Lovell of UBS, the former Fed governor, Randy Krosner, Jeff Rosenberg of BlackRock, Mohammed Al-Erin of Queen's College, Cambridge. Those four in the next 60 minutes, looking for 240K. That median estimate, according to our colleague Chris Dancy, the highest median forecast before payroll payrolls. Lisa, going all the way back to September 2022.
You asked the Tessera House of Wells Fargo, and she said you kind of have to add in an extra 25K just to sort of get up to speed, which just shows how little everyone understands this labor market that has been buffeted by a whole bunch of different trends.
Listen to these numbers. AMH, 3-month average, 276. The estimate today, 240. Jefferies, 280. Goldman, 275. A whole group around 250.
And what did we just hear from Sarah Wolf? 265,000 per month is the break even going into this payroll report, even though they're expecting a little bit under that. So you can just see how robust this labor market is, which is why everyone is looking at wages. Because if you want to look at what's going on in inflation, you need to see if the strong supply in the labor market, Jay Powell said it this week, he said they continues to see a strong pace of immigration. Is that putting a lid potentially on wages?
Let's go with Citi, 215, their estimate. Their work this morning from Andrew Honhorst and the team. Downside risks, sensitive to the downside. Lisa, after Powell took hikes off the table at this week's FOMC meeting, downside risk to yields are magnified by downside risks in today's jobs report. Asymmetry, I think, is the word of the last couple of days.
And this is something that Andrew Hollenhorst has sort of been on the peripheries with, at least in terms of saying it out loud. But there are a lot of people in the market that seem to be agreeing, because what you can see is an increasing bringing forward of rate cuts. I understand you said, yeah, they're bringing it forward to November, which doesn't seem either feasible or like it's that soon. However, it does highlight how much this did change things in terms of people's understanding of the Fed's reaction function and what it would take for them to actually come in with cuts.
Think how much things have changed. You start the year, 7 cuts priced into the market, all the way down close to a single cut before the Fed Reserve meeting this week. It can swing the other way with ease, dependent on the data in the next couple of months. Where I struggle at the moment, the consensus position on Wall Street is that you can't get cuts in September. Don't understand it. We had QE3 back in September 2012. If the data's there and they've led us up to that position through the summer, why can't they cut in September if they need to?
To push that a little bit further, if we do see that weakness that justifies a cut and it's enough to actually cause some sort of pivot or turn, there is a concern.
Pivot on a pivot.
I know, let's just move on. But if it does do that, wouldn't that be negative for risk assets? Because essentially, wouldn't that be highlighting a weakness that everybody just shrugs off and says, oh, it's just a pocket here, a pocket there, but it all come together in a good way?
This conversation could change in either direction at 8:30 Eastern Time. That data, 25 minutes away. Equity futures right now on the S&P, the scores look like this. We're positive by about 0.4% through Thursday, just about down on the week, just on the margin on the S&P 500. Yields have been lower through most of the week. I said it early this morning. ECI, the Employment Cost Index, which came in with an upside surprise and took yields higher, 5% on 2s, 470 on 10s. That data point, Lisa, feels like a lifetime ago.
Especially because Jay Powell didn't really address it, but it raises this question, can they really cut unless there's weakness, right? I mean, basically people are discounting that. Again, are we cutting for the right reason, right? I mean, I go back to these narratives and I understand, we were told at the top of the show that that was silly to do. However, it is hard to understand from a theoretical standpoint framing what's going on right now.
The jobs report just around the corner. Let's start with our top story. It is 25 minutes away. We're looking for 240K. Nadia Lovell of UBS saying this: rate cuts are just delayed, not cancelled. And the Fed put is alive, which should help support equities. We recognize equities could stay choppy near term, partially due to positioning and technical factors, but we believe the market's broader uptrend will persist. Nadia's with us around the table. Nadia, let's start with that Fed put. Why is it alive and well?
Chairman Powell made it clear this week by removing that tail risk and saying that it's unlikely that the next step is going to be a rate hike. And so that should provide a floor to the market. He's also pointing to the employment numbers. Any signs of weakness in the job numbers will cause the Fed to move forward and reduce monetary policy and begin the cutting campaign. We think that, the Fed will likely start to cut in September, not because the economic environment is weak, but more so that we think that inflation will start to back again on that disinflationary trend and get back towards a 2% target next year.
Lots of bond strategists come on the program and tell us how bonds would respond to any given number. They're basically telling us that the bond market would be more sensitive to a downside surprise than they would be to an upside surprise, because they believe that after Chairman Powell's re-established the reaction function of the Federal Reserve, it puts a lid on yields. What would it mean for equities? Does it mean the same thing? Are we more responsive to downside surprises than upside surprises? Or is it just good news is good news and bad news is good news? How does this work?
I think at this point is, good news is good news and bad news is good news to a point, because at the end of the day, what matters for equity is the growth backdrop. We don't want that to deteriorate too much. And so if economic growth can still continue to hold in there, then that should be enough to sustain the equity markets. And the earnings season itself has been quite positive. And so we think that that will help the market start to resume its upward trend in coming weeks. And then, you have buybacks that's coming back to the market too.
The level of confusion and lack of conviction really is sort of shocking to me, because we're all at this point where we can't really figure out where to place things, and neither can the Fed, and they've basically been pretty vocal about that. How much does that contribute to your expectation of a great degree of huge price swings on some data point? How do you sort of prepare yourself for a level of volatility that we haven't yet seen, but on the broad market sphere, but we see in individual stocks where you get, $2 trillion companies that are swinging 13% in a couple hours?
Yes, so we really think that the market is likely to remain choppy here. The market is also looking for some clarity around inflation a bit. We could get that in the next couple of weeks when we get PCE. We want to see how much of that first quarter hotness in CPE was due to seasonal factors or catch-ups and so forth. So you sort of need some clarity on that. And as I noted earlier, we will be past the blackout period for buybacks. Overnight we saw, huge announcement in terms of buyback. So large that, when you think about it, it's more than the market cap of 80% of the S&P 500. And corporates are a big part of this story. We also think that, it typically happens that investors take a few weeks after the earnings season to just absorb all the information, Lisa, and digest it and analyze it. We think that that will happen. And once they look through the earnings season and see that, we have corporate earnings that are growing at double-digit rates, and that will encourage people to step in and buy this market.
With respect to the buybacks, how much do you follow them? How much is this basically a market that you cannot understand the macro? So just put it aside. Take a look at whether you're buying back the size of Ford and GM combined, plus another couple companies. How much do you just say, well, that looks pretty good. We're going to go for value. Let's just follow that.
It is important in terms of providing a floor to some of these stocks. Reality is corporates are a big buyer, but it's we just don't focus just only on buyback. It's an incremental positive, but overall, what's at the end of the day, what's going to happen is what's happening with corporate earnings. And finally, this earnings season, we're seeing the rest of the market, that 493, they're growing again, Lisa, for the first time in over a year. And we expect that to broaden out as we get to the rest of the year. And particularly outside of tech, which we continue to like, we're super excited about industrials. We've been talking to clients a lot about looking at AI through an industrial lens and all the spending that's happening for data centers, tremendous amount of spending. These companies are at the forefront, at the epicenter, really, of the data center build out.
So Chris Barone, actually, he mentioned this, and he said, okay, no, this is silly. If you want to own AI, own AI. Utilities, own utilities because of utilities. You don't agree?
That is different. I'm talking about industrial. Utilities, yes, utilities are catching a bit from the AI trade, helping them to overcome the headwinds of higher rates. Usually you don't see utilities moving up in a higher rates environment, but the industrials companies, you think that there is, a bottleneck around getting an AI GPU chip. Guess what? When I talk to our industrials analyst, he tells me there is a huge bottleneck around large transformers. Those are what's needed to be able to download power from the grid to these data centers to be able to cool them. It takes about 2 to 3 years, given the background right now, to get one.
Nadia, marry these two stories together, AI and the jobs market, and this print we're waiting for. How much are you seeing in these companies that are starting to use AI actually mean that they can have a little bit less human workers?
Yes, you're seeing improvement in efficiencies. We've heard some companies talk about it, improving efficiency at 80% and so forth. That will have implications for the job market going forward. But as we've seen in past technological changes, it just means that, jobs are shifting. It doesn't necessarily mean it will be detrimental to the job markets. At the end of the day, we all want to be more productive, and use our skills in other ways that adds to productivity to overall economic environment. So we think that you will see a shift, but it won't be too disruptive to the job market, and it will take some time to get there.
So how do you want to play this broadening out? Where do you go beyond industrials? What are you looking at?
We're also looking at healthcare. Again, some secular trends there. Look at the numbers that we saw this past week in some of the obesity names, And despite that strong demand, constraint is what's holding back growth. Supply constraint. We should have more capacities coming online later in this year, and that should help even boost the top line more for some of these diabetes and obesity companies. And the reality is we're seeing new data from some trials ongoing in some companies companies that I won't name, but you know what I'm talking about. It's not just the two top companies that are in obesity. You have some potential other players that might be coming in subsequent.
Not just Novo and Lilly. I can say that for you. Nadia Lovell of UBS. Nadia, thank you. You're one of the best. Appreciate it. Buybacks. Listen to this for a number. I was speaking to Robert Schiffman of Bloomberg Intelligence last night. He's one of the best. You should reach out to him. Apple has rewarded shareholders with more than $839 billion since 2012. And that number after yesterday is higher.
It's a shocking amount. I mean, what did Nadia just say? It's actually bigger than 80% of the market capitalization at the S&P 500. At this point, how do you view this company, though? I keep going back to this. Is this a growth stock, or are you just counting on them just to...
That 110 billion, I think, is the equivalent of, say, a Boeing or a Lockheed Martin. So think about how large those companies are.
Yeah.
Pretty amazing.
Quickly, almost both of them combined, depending on how things go.
Yeah, for one of them in particular. We hope that gets better, I think, for all of us, right?
Yeah, for all of us.
I think we all need Boeing to get better. Equity futures right now on the S&P, positive by 1/3 of 1%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Probably worth checking on Apple, given that huge buyback is up 6%. Of course, it wasn't just the buyback. It also defied some of the worst of the gloom. But let's be honest, also raised questions on its China sales versus weaker showing third-party channel checks. So that $110 billion, you already went over how big it was. To be fair, it topped $100 billion, which was the prior record, which was also Apple. Dan Ives of Wedbush, long an Apple bull, wrote that betting against Cook and Cupertino in an AI-driven supercycle and a $110 billion buyback is the wrong move for investors. Shares of Coinbase, on the other hand, sliding down more than 4.5%, even though it had a first quarter beat. Its trading volume and app downloads had surged when spot Bitcoin ETFs were launched in January. But Mizuho analysts point out that all of that was largely to be expected with the record run up in Bitcoin. On the other hand, there's potential regulation, signs of dropping transaction revenue that overshadowed the beat. Now, I think I might have one of those companies that Nadia mentioned but didn't name. It's Amgen. Those shares are surging in the pre-market thanks to their push into obesity drugs. The CEO said he was very encouraged by a trial of their experimental obesity drug. Now, if approved, Amgen said that patients would use a handheld auto-injector just once a month or even less frequent single injections. Now, that compares to Wegovy and Ozempic, injections you need to take once weekly. And that potential competition has sent Novo shares down nearly 4% this morning. That's your Bloomberg Brief. John.
Danny, she won't confirm or deny. Won't confirm or deny. Danny, appreciate it. Thank you. What do we say about payrolls? The most important since the last and until the next one.
Yeah, basically every time. I love how analysts come on the show and they're saying, yeah, it's one number, you need a number of numbers. And then some of the commentary on the street, gonna be wild, except huge balls. So that's some of the, the dissonance here.
That should be the promo for the next 15, 20 minutes or so. It is gonna be wild at 8:30 Eastern time. Up next, the jobs report, just around the corner.
The unemployment rate's been below 4% now for 2 years. Again, as the process of normalization continues, it's hard to get worried about how it's all evolving.
Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Here are the scores on the board on the S&P 500 going into this jobs report. Equities are positive by 0.4%. Yields are a little bit lower. We're down 2 or 3 basis points, 4.5527. How different that bond board, that screen looks, Lisa, compared to where we were after the employment cost index earlier this week.
When people were still talking about rate hikes, and we heard Jay Powell talking about the potential for no cuts or a lot of cuts, but not the other thing. So it seems like right now, people are just wondering, okay, how quickly can we cut rates, and will this report confirm that?
The 2-year was at 5%, it's now at 4.86. The 10-year was looking at 4.70, it's now at 4.55. Under surveillance this morning, the jobs report just around the corner.
It's hard to get too nervous about the health or the state of the labor market. It looks like we're still really looking healthy. That foundation for the economy is solid. I think that we need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market. The unemployment rate's been below 4% now for 2 years. Again, as the process of normalization continues, it's hard to get worried about how it's all evolving.
So here's the latest. The April payrolls report just moments away. The median estimate in our survey here at Bloomberg calling for 240,000 jobs. Former Fed Governor Randy Kroszner joins us now to discuss. Randy, great to catch up with you, sir. Last time we spoke ahead of this number, you said the focus should be on wages. Is that still the case?
I think definitely still the case. That you can really see from Jay Powell's remarks. He's laser focused on what the labor market means for inflation. And the productivity numbers came out not quite as strong as they had been from before. If the productivity numbers aren't strong, that means that it's very hard to have continued 4% wage growth and the inflation rate getting down to 2%.
Randy, with that in mind, how strong is the relationship between headline payrolls growth and wage growth?
And so there's a reasonable relation, but not a perfect relationship, because a lot of it has to do with expectations. Where do people think inflation is going to go? And also making up for lost time over the last couple of years, where inflation was much higher than wage growth, and people are still saying, hey, I need to catch up because it's so expensive for me to just put food on the table for my household.
Randy, are you surprised that in light of that, Jay Powell didn't talk at all about ECI?
Well, I don't think he wants to emphasize one particular number too much, but certainly that is one of the things that they are thinking about, because the most important input price in the entire economy is the wage.
Well, do you think that this is actually a legitimate reason to take rate hikes off the table? I mean, basically, that's one key question. Why do you have confidence to take that sort of potential risk out of the market's expectations in light of data points that have shown hot wage inflation?
So he's hoping that it's not going to be an uptick. That certainly we've seen the inflation rate kind of come down very significantly, but kind of stall. We've talked about this before, the kind of last mile problem, getting down to that 2%. So I think he's thinking that we're still in restrictive territory, but he doesn't want to be too restrictive because he wants the labor market to be as strong as it can be, bringing us down to 2%, that immaculate disinflation, that Goldilocks scenario.
Do you agree with him? And this sort of piggybacks off the conversation we were having with Sarah Wolf of Morgan Stanley, where she said, part of the calculus here is that lower income families are pretty much struggling. They're pretty much in recession. And he wants to keep the labor market as strong as possible so at the next leg, they can start to catch up. How much do you think that is behind some of what some people are interpreting as a pretty dovish message from this Federal Reserve?
So I think he wants to keep the labor market strong for all of the different groups, but certainly that is an important focus. When in 2020 they came out with their average inflation targeting approach, they really emphasized trying to keep the labor market running a little bit hotter to help people at the lower end. So I don't think that's been forgotten.
Randy, what do you make of the fact that the Conference Board, it's actually concerns not about inflation so much with U.S. consumers, but actually concerns about wages and potentially their next job?
And so I do think that there are some signs the labor market is starting to slow a little bit. I mean, certainly the number of unemployed workers per job opening, that's changed a bit to make things a little bit less sanguine for the markets. We'll see what happens with this employment report. I think at some point we are going to see the job market slow, and at least anecdotally, I've been getting more and more kind of feedback that we're seeing that not only at the lower end of the market, but also at the higher end of the market.
Randy, do you think that the headline figures are masking true weakness under the hood?
It could be. And so we really need to look into the details of the numbers to see what sectors, what pieces are showing strength and weakness. And so, I think things overall look pretty good. And so far, we have had something close to an immaculate disinflation without really any uptick in the unemployment rate and the inflation rate coming down from almost 9% to, depending on how you measure it, 3% or so. That's a pretty good record so far.
How much conviction do you have in the soft landing versus the prospect of a hard landing that we were hearing from the likes of Citigroup's Andrew Hollenhorst, that this weakness is actually going to suddenly materialize at a time when the Fed has not yet cut rates?
So I think, as I think you've heard me say before, not soft landing, not hard landing, hardish landing. So I think at some point you will have to pay the piper. I think at some point you're going to start to see the unemployment rate move up. And part of this is because Fed policy has only become really restrictive relatively recently. If you look at the inflation-adjusted interest rate, that is the real interest rate, it's only become positive over the last 6 months or so. Same thing for wage growth. Real wage growth had been negative and now has become positive only over the last 6 months. That's great for families, but it's going to be less desirable for firms to be hiring people when they've got to pay them 4% more and they only can sell things at 2 or 3% more. So I think, given typical lags of sort of 9 to 18 months, towards the end of this year, you're going to start to see the unemployment rate tick up. And will it be recession? Not necessarily, but I do think you're going to see a slowdown.
Randy, you've been saying this for a while, and I understand the logic. Consumers lose confidence, corporations lose pricing power, and ultimately you reach for that lever that no one wants corporations to reach for. But it happens in cycles. They start to lay people off. There was a feeling that coming out of the pandemic that maybe we'd see a hoarding of labor because of the difficulty that certain corporations had hiring. Where would you look for weakness first, Randy, with that in mind?
So I think I'd look for in different parts of the, look at the overall numbers that we'd be seeing now. If you see lower wage inflation, that would start to see that, people aren't pushing as much as they were. Also, if you're seeing less quits, which we certainly have seen a bit, people seem to be a little bit less certain about the market. You had the Great Resignation. Everybody was willing to quit because they knew they could move over someplace else and get paid more. We're not seeing as much of that. So I think those are the beginning signs of at least a little less heat in the labor market.
Randy, enjoyed this. Always fantastic. Thank you, sir. Randy Kroschner there, the former Fed governor, breaking it down for you. 6 minutes away from that payrolls report. Mike McKee joins us now. Mike, you'll be breaking down the number. Walk us through what you're focused on this morning.
Well, two things, John. I think the first thing that's going to get everybody's attention is the headline.
I believe we've lost that line, Michael. You back with us? You're back with us, Mike. Carry on, please.
I'm here. Do you? All right. They invented the internet out here, so it doesn't work. We get 240,000 is the economist consensus. That's the highest since September of 22. So economists are betting on a fairly strong number, and the whisper number is 244. So everybody is kind of leaning in the direction of strength. If we don't get that, then that will cause a reaction on Wall Street because people are looking for that slowdown that Jay Powell is talking about. And then, of course, the other thing is always average hourly earnings. Do we see a difference there that suggests that we're seeing wage pressures, because we got that in the ECI last week?
Mike, we apologize for the technical connection. We're going to reestablish things and get that set up for 5 minutes' time when the payrolls number actually drops. Mike McKee, thank you, sir. He'll be catching up with Goolsby a little bit later of Chicago as well, so don't miss that conversation. I think 10:30 Eastern time. Then it's Goolsby and Williams sitting down together this evening, responding to this jobs number. So fantastic lineup of guests right here on Bloomberg, and also the Fed reaction that I'm sure you all want following this number that drops in about 4 minutes' time. The number we're looking for, 240K. That's the estimate, the median estimate in our survey. Mike McKee's going to break it down. Mohammed Al-Arian, Jeff Rosenberg reacting. Your jobs number drops next.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The jobs report, 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures, positive by 0.4%. On the NASDAQ, up by 0.6. Switch up the board in the bond market. The 2-year yields lower by 2 basis points, 4.8432. On a 10-year, down 3 or 4 basis points, 4.5465. The estimate in our survey, 240K. The number, 175. Mike McKee can break it down. Hey, Mike.
John, we seem to have some good news, at least as far as Wall Street is concerned, thinking that maybe the economy would slow, and 175,000 is certainly slow compared to what we have seen in recent months. Last month, remember, the original was 303,000, and that has come down to 175 this month. I'm looking for the change here, but the unemployment rate goes up a little bit, 3.9%. Change in private payrolls, 167,000, 315. Last month was revised higher to 315, so we have really come down almost half of what we had last time. The unemployment rate, as I mentioned, 3.9%. Average hourly earnings, only 0.2%, which is going to be seen as very good news. There's some statistical reasons that a number of economists thought it might be a little bit hotter, which pushes the average hourly earnings on a year-over-year basis below 4%, which may be the first time since the pandemic, 3.9%. Weekly hours, 34.3. That's a tick down from what we had the prior month. And the labor force participation rate is unchanged at 62.7. Manufacturing payrolls up 8,000. There were 0 jobs expected, so manufacturing may be making a little bit of a comeback. But overall, 175, a negative 22,000 for revisions, which all had to come out of probably the March numbers because April revised up. I'll dig into this, and you guys can get the brains to tell us what it all means.
Mike McKee, there is a character from a fairy tale you're going to hear a lot about today. Her name is Goldilocks. This is what it looks like. 175, decent but not too hot. A downside surprise, the estimate was 240. If Wall Street could have made up these numbers itself, Wall Street would have come up with these numbers. 175 on payrolls, wages a little bit softer. Guess what the market's doing? Rallying, and rallying hard. We often say the first move is not necessarily the right one, and maybe this doesn't stick, but this certainly makes sense. We're up by 1% on the S&P 500, up by more than 1.3% on the NASDAQ. On a Russell, up by 1.5. If you switch up the board and get to the bond market, we've talked a lot about the asymmetry coming into this number, that this number, if it was lower than expected, would move this market more than if it was higher than expected. It is. Yields are lower by 14 basis points at the front end. Think about this week. We've seen 5% on a 2-year. You're now seeing the low 470s at 473.47 on a 10-year. We had a look at 470 this week. Said it early this morning, twice already. The ECI report, the employment cost index, feels like a lifetime ago. We've gone from 470 down to 446.69 and down 11 basis points on the session. It's a double-digit move across the curve, the 2-year out to the TO. Over in Japan, it is about 9:33 p.m. Friday evening, and I can tell you the Ministry of Finance is happier with this one. Dollar yen gapping lower by 0.9% to 152.20. Bramo, I think we call that the right kind of downside surprise.
It's basically everything that the Fed would want and then some. Basically, you have lower than expected wage inflation and a number that's cooler but not too cool. That said, I will just point to the fact that revisions for the prior month were actually revised upward, so it was not necessarily all this sort of Goldilocks type of feel. But to me, the asymmetry point that you've been bringing up absolutely nailed it, which is essentially what we were going to get was a big rally or a bigger rally. And right now, it's the bigger one.
Right now, you've got a big rally. We're up by 2 percentage points on a Russell, up by 1% on the S&P 500. The opening bell a little less than 60 minutes away. If you are just joining us, here are the numbers for you. 175 is the number. The estimate was 240. That's the headline payrolls print. Looking at unemployment, it comes in at 3.9%. Previous number 3.8. The estimate 3.8. And wage growth month over month, 0.2%. The estimate 0.3. To react, here's the lineup. Mohammed Al-Erin of Queen's College, Cambridge, alongside BlackRock's Jeff Rosenberg. Mohammed, first to you, your reaction to this one.
You said it, John. A Goldilocks report that will please the Fed and please the markets. I'm not particularly surprised on the miss on job creation because we've been running at very high levels for the year and a monthly average of 251,000 before this one. I'm a little bit surprised on the wage, the 0.2. That's the one that surprises me. But overall, it is a Goldilocks report.
Mohammed, at first look, how would you explain that? How would you explain this continued strength in payrolls growth and this little weakness, touch of weakness, softness in wages?
I know how it will be explained. It will be explained by new entrants into the labor force at much lower level, at a much lower level. I'm just surprised it has made that much of an impact. So that's something that one needs to look at much more closely.
Jeff Rosenberg, I'd love your take on this, because right now the market is celebrating. Are you celebrating also? Do you think this is a reason to buy, or do you view this as basically a lot of noise for people who are just looking for any direction at all?
Well, I think Jonathan said it. This couldn't have been scripted better. This report runs the tables for a good report. This is bad news, a little bit is good news, but it's really just about, how bearish we got. Jonathan mentioned it, ECI, the rate moves, the expectations in front of Wednesday's FOMC. So some of this is just positioning. You had a lot of bearishness, so people put shorts on. There was a big momentum to higher rates. But this is a good report across the board for validating what we heard from Jay Powell on Wednesday, that kind of what me worry about inflation. No, things are going to slow. Don't get overexcited. And I think it's a little bit of that overexcitement on the short side that's being wrung out of the markets right now.
Mohammed, does it concern you that we saw the unemployment rate tick up to 3.9%, the sort of incremental shift up about a half a percentage point from some of the recent lows?
Does it concern me? Yes, because people are losing their jobs. But let's not forget, we've had 27 straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No. But if the increase accelerates, that would really worry me. Remember, especially at the low-income side, wage are key to consumption and key to economic growth. Pandemic savings have been run down, credit card balances have been run up. So wage income is absolutely critical to the well-being of this economy. So 3.9% is still a really good unemployment rate, but I wouldn't want to see it get close to 4.5% anytime soon.
This softer print, though, that we're seeing and digesting right now, Mohammed, is this enough for potentially people to start talking about cuts this summer?
Oh, I suspect that what was pushed back to December got pushed, I don't know which way we go. Anyway, got pushed forward to November before this, and after Chair Powell, this will take us to September. There is a bigger issue, and others can speak to it much better than I can, including Jeff, is this volatility that we're seeing in the interest rate structure. It is causing havoc elsewhere in the world when U.S. rates swing as much as they do on a short-term basis. So this volatility, which we are continuing to see in rates, risks breaking something elsewhere, and that's what we got to keep an eye on.
Well, let's get into that. So the next stop for this conversation, for anyone who wants the calendar, May 15th is when we get the CPI report, so this can all change once again, as you all know. Jeff, let's talk about that. How much expectations have swinged? How much the narrative has changed? I remember a conversation we had with Aberdeen, James Athey. He called it narrative table tennis, narrative ping pong, just back and forth, back and forth. We've gone from 7 cuts to 1. Arguably, by the end of today, we'll be talking about 2 again because of this jobs print. Jeff, what do you make of that? Just how quickly we've gone from one direction to the other in rate pricing?
Well, it's because the Fed has abandoned forecast-based monetary policy, right? We basically have had a very bad experience with trying to forecast inflation. So we've abandoned forecasts and we react to the data. And we're reacting to the data because the Fed reacts to the data, and that's basically what they tell us to do. And it's very hard print to print to know where that data is going. We've had serial degrees of surprises. And we're continuing to see those surprises. And so that's why there's this heightened degree of volatility, because the Fed is basically no longer willing to provide a forecast, to stick with its forecast, to give the market a clear trajectory. And so we're really forced to react and change those expectations for timing, December, November, September, July, based on every other data, every single data point.
Mohammed, you've said this a million times. Every time we've spoken on Payrolls Friday, the lack of a strategic anchoring at the Federal Reserve contributing to this whipsawing that we've seen in rate pricing on every single data point. You've talked about them being hypersensitive to incoming information. In the Financial Times, I saw your recent article. Chair Powell's dovishness is right, not for the reasons that he believes. Can you talk to us a little bit more about that, Mohammed?
Yeah, and I want to thank Jeff. I wanted to reach out and hug him through my computer because he just said what I've been saying, which is rather than provide a strategic anchor to markets, the Fed got on the roller coaster of reacting to high-frequency data. And therefore, we have a very reactive Fed. And what does that do? It amplifies the volatility in the market. So there is a concern that the Fed is overly data dependent. I think that overly data dependent stance is what may end up leading us into a Fed policy mistake. I hope we don't get there. And that's why a strategic view is necessary. And I suspect if you were to take a strategic view, you would not have validated the market's overreaction from going from 7 cuts all the way to 1, with some people even say you're going to get a hike. You would have said, no, this economy is slowing. It's slowing in a gradual fashion. Let's not push it into something more dramatic. And you would stick to your 2 to 3 cuts this year. But this Fed is data dependent, John, so I don't know where they're going to end up.
Jeff, what's your take on that, this idea that the fluctuations in and of themselves, sort of whipsaw action and whipsawed narratives in markets, is actually creating a potential headwind to how this all plays out and potentially to the Fed actually achieving their soft landing?
Well, I mean, it is a headwinds, but we also have to see the other side of this, that the equity market has been, much more resilient to these shifts in the interest rate narrative. And when you think about financial conditions and the transmission of market volatility into the real economy, it's mostly going to happen from the equity side. Not to say that interest rates and credit spreads don't matter, but we're talking about volatility around elevated rates of base rates of borrowing in an environment of very muted and compressed credit spreads. So the marginal financial condition easing and tightening, it's coming from the equity side. And there the story has been much more about the numerator, much more about these secular growers, the tech story, the incredible earnings that we're seeing. And as long as the rate picture stays bounded, unlike what we had over the last 2 years with these huge swings from Fed policy, inflation uncertainty, I think you can mitigate some of that transmission of the volatility that we're talking about as a result of the Fed's policy shift from forecast to data dependence into the real economy, because you're not really seeing it transmitted through the equity market.
But Jeff, do you think that there is sort of a challenge to the broadening out trade? To Mohammed's point, that this actually could cause something to break outside of the United States at a time when a lot of people are saying the U.S. is no longer so exceptional, the rest of the world is catching up. Does this challenge that?
I mean, there are certainly challenges. Jonathan highlighted the yen reaction, the FX component of interest rate divergences. You always have those degrees. I think what we've seen, though, is a remarkable degree of resiliency in the global economy. I think we talked on Wednesday about the differences in emerging market sensitivity to Fed policy this time round. Really much more about a function of the change and the more traditional policy approach happening in emerging market central banks, much more credible policy, dampening some of that pass-through. So I think you have certainly the core interest rate volatility. You look at the MOVE index, it was once at 50, now it's between 100, 150, 200, much higher degree of interest rate volatility. And that has its problems, as Mohammed laid out. I think we're seeing a little bit less pass-through, though, in some of these more traditional areas, and that can kind of mitigate some of this concern about the effect of the policy uncertainty from data dependence into the real economy. Not taking away what Mohammed said, though, I agree with his point, that you still have the potential there for a policy mistake as a result of no longer anchoring to forecast-based policy.
Let's reach for dollar yen. Let's talk about that move, not just on the session, but talk about it on the week. It's been phenomenal. Moments ago, we had a 151 handle on dollar yen. Right now, just about holding on to 152 at 152.24. On the week, it's about 4 percentage points of yen strength. But go from the highs of Monday. Monday, 160.17. From those highs to where we are, you've seen a move of more than 5 percentage points. Yen strength big time. I've mentioned the time in Tokyo repeatedly. It's 9:44 p.m. going into the weekend in Tokyo. Raise a glass. Sort of, walk away feeling pretty good going into the weekend, Bramo, because that's the stronger Japanese yen the Japanese authorities wanted.
They could either walk away or they could lean in, do a little more intervention now when they're in a holiday and you're actually getting a tailwind from the U.S. economic data. And you want to be short us? You want to be speculative? Good luck.
Mohammed, I don't know if this move sticks, but I'm sure they wanted to. How happy do you think authorities are abroad after this number?
So certainly the Japanese authorities are very happy. Between Chair Powell's more dovish than expected press conference and today's number, a lot of the pressure has been relieved. And like you say, we were at 160 on Monday, and we are at 160 risking another disorderly move. I suspect that around the world, people will feel some relief. You have emerging market economies that need to cut interest rates from a domestic side, but are afraid of the consequences for their currency. Yes, Jeff is right. They've been resilient so far, but the degree of resilience has come down a lot. So we shouldn't test them too much. You have the ECB that wants to diverge from, for good reasons, that wants to diverge from the Fed and keeps on telling us we're not Fed dependent, but knows in the back of its mind that there's a limit. You know, for the rest of the world, it's about the movement in the U.S. Yield curve. It's about what U.S. rates are doing. For the U.S. economy, I agree with Jeff. It's about the equity market. But for the rest of the world, because of exchange rates, it's about what U.S. yields do.
Well, let's sit on the rest of the world, Mohammed, just for a beat. So the conversation's been dominated, as you know, over the last month with words like exceptionalism. You've written about it. Divergence. There will be some people getting excited about the prospect of convergence, that this was peak exceptionalism when we're moving on beyond that, that maybe we've seen the peak in the US dollar, a peak in US yields. Do you think those conversations this morning, Mohammed, after one job sprint, are a little bit too premature?
Totally too premature. There's three elements to this exceptional U.S. behavior. One is its growth performance. Two is the manner in which it's investing in the future. And three, it's its ability to get away with a fiscal stance that other countries cannot get away with. In order to get convergence, you would need convergence on all three. And we're not going to get convergence on all three. U.S. is going to remain exceptional. Its growth performance may not outpace others as much as it has, but it is the only major economy in the West that is seriously investing in tomorrow's engines of growth. And because of the role of the dollar, it can run an irresponsible fiscal policy for much longer than others can.
They retain the privilege of acting recklessly, maybe for a little bit longer. Lisa, let's be clear. Yes, it's a downside surprise, but these numbers are still pretty exceptional.
Well, that's exactly the reason why people are saying it's Goldilocks, including yourself. You nailed it with the very beginning, because essentially this is not a market that's flat on its back. This is not a labor market that's slowing down or grinding to a halt. It's one that's moderating. That's what people are going to say. And it's one where wage pressures are showing to not be as great as some people feared, which is exactly the recipe that the Federal Reserve was looking for.
Let's put some numbers on that, Bramo. Let's go through things. If you are just joining us, welcome to the program. The jobs number dropped about 18 minutes ago. 175 was the number, 175,000. The median estimate was 240. The previous number, a lot higher than this, of course. And the previous number sparked a conversation about whether we were running things too hot. Look elsewhere. Unemployment comes in at 3.9%, a little bit higher than the previous read of 3.8 and higher than the median estimate of 3.8. The wage growth figure, average hourly earnings month over month, 0.2%. That is a downside surprise. We were looking for 0.3. Now, the read across is pretty obvious in financial markets. Equities had a look at this and ran away high. Much higher, up by 1 percentage point on the S&P 500, the NASDAQ up by 1.6, the Russell up by 2 full percentage points. You turn to the bond market, this is precisely what we've been talking about throughout the whole of this morning, the potential for a small downside surprise to generate a big move lower in bond yields, and that's what you've got, a double-digit move at the front end, down 10 basis points to 477, down 9 on a 10-year to about 450. We've mentioned foreign exchange already, but as you might expect, the dollar is weaker against the bulk of G10 this morning, all of it. Look at it against the Japanese yen, dollar yen 152.38 on a week that we've had a look at 160, an unbelievable turnaround in that currency pair. Mike McKee, you've had about 20 minutes to go over this one. What jumps out for you?
John, the interesting thing about unemployment, and I'll reassure Mohammed a little bit with this, is that it was a very little move. You have to go out to 3 digits to see what really happened. Unemployment rose by 3.865%, which rounds up to 3.9. Last month it was 3.829. So we're at about 2/100ths of a percentage point higher in unemployment. 63,000 people were unemployed according to the household survey. 25,000 additional people were employed, and the difference between the two is that 2/100ths of a percentage point. So it's not a big deal that unemployment went up, and of course the Fed's been looking for that. The other thing that stands out is that it looks like March April rather, was a real outlier because not only was the number revised up there, March was revised significantly lower, and we've seen some changes in the unemployment rates. Remember, last month, black unemployment skyrocketed. Now it comes back down again. It was 6.4. It's down to 5.6, an 8 basis point drop there. So it looks like April was an outlier with its strength, and March brings us sort of back into the pattern where we're starting to slow down. Some other interesting numbers: governments lost jobs, transportation and warehousing gained a lot of jobs, and they'd been losing jobs. Construction was up 9,000, manufacturing 8,000. It's kind of a broad strength in the economy, but at lower levels.
Mike McKee, you're sitting down with Goolsby a little bit later, about 90 minutes from now, actually. What's the first question after this one?
Well, in the past, Jay Powell has said that they get the numbers in advance when they have a meeting that week. I want to find out if that's true, because that might explain why he was so dovish and why he was so confident that inflation would continue to fall, even though Wall Street was having a bit of a heart attack. That, and then where does he think inflation is going to go and why? That's the big thing. Is it monetary policy that is pushing inflation down, or are we going to see these whack-a-mole one-offs keep popping up?
Mike McKee, looking forward to the conversation. Thank you, sir. Still with us for a final word, Jeff Rosenberg of BlackRock and Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, for a final word to you first, what are you looking for from the Fed speak going into the weekend and into next week?
So first I want to thank Mike for reassuring me, and thank him also for wearing blue after the Mets' big win against Chicago yesterday. Thanks for that, Mike. That's really important. I just would like to hear other Fed officials reiterate what Chair Powell said.
What about you, Jeff? I mean, is that basically your takeaway, too, that basically you just are not going to wait to hear what other Fed officials are going to say? And otherwise, it seems like this is the same place we were before?
Well, I think this is going to, kick off the narrative about long and variable lags to the downside. And what a remarkable shift, bookmarking the week. The beginning of the week was wages accelerating, surprise to the upside, kind of a lot of hawkishness. Now you beat on the downside in terms of AHE and the payroll report. It drives the narrative to the other direction. So there's a lot of short-termism, but this Fed is anchored on a couple of things. That's what I want to hear about. Number one, they're anchored on this concept that it's about long and variable lags. They're worried about those long and variable lags, the policy error that Mohammed talks about. And that creates this asymmetry. And they're worried about that because they believe that this policy is that degree of perceived restrictiveness, and this is going to ease financial conditions. I mean, that's the flip side, is you're running monetary policy with financial conditions in the driver's seat, not interest rates. So sometimes when the market gets ahead of itself, it's too much of a good thing. Wouldn't say that's the conclusion to draw from today, but those impacts, that assessment is what I want to hear from the speaker.
Well, we'll see where these prices close at the end of today. Hey, Jeff, great to catch up. Jeff Rosenberg there of BlackRock, alongside Mohammed Al-Erin of Queen's College, Cambridge. Just some final thoughts around the table. Median estimate was 240. Ramo, we got 175. If you look at the estimates on the street, only 3 economists south of 200K. We talked a lot about this morning, conditioned by upside surprises that everything started to climb a little bit higher on Wall Street, and that was your downside surprise, and they've been rare over the last few years.
I'm not sure what to make of this. I'll be really honest. I think the only thing I can make of this is that this was a market that was coiled to move. And it seems like a lot of people were looking for some kind of big move, and they got one. Whether it sticks is going to be a key question. Whether this changes anything, I don't know. I want to understand the composition issues that went into average hourly earnings to understand exactly where the job gains were and how that might have affected where things came in there.
I know we talk about a lot what this means at the Fed and for Chair Jay Powell, but it's once again below 4% in the unemployment rate for the 28th consecutive month in an election year. But Enda Curran talks about the fact that it's a lagging indicator. Look at the jobs market. Where is this jobs market going to be 6 months' time before the election in November?
I want to do 2 things. I want to give a shout out to the team at Citi, Andrew Hollenhorst, Veronica Clark, who were looking for a downside potential on jobs growth today. And we're talking about asymmetry repeatedly over the last few days. So shout out to them. At least so far, so good. I want to finish on this, though, Lisa. The swings we've seen in the market this week, We've mentioned this already. The employment cost index feels like a lifetime ago. The numbers we saw on Monday on dollar yen, 160, this morning a 151 handle. The levels we've seen on yields at the front end, 5%, all the way back down again. At the long end on a 10-year, 470, all the way back down again. This narrative is just swinging from one point to the other repeatedly. We're being so sensitive, to Mohammed's point, to incoming information every single month, every week, every single day.
And how much does that really challenge the broadening out kind of idea if a lot of other countries are depending on the U.S. stability to kind of help them gain some trajectory? But also, is there some sort of tightening effect of the wild swings? Or is it simply just with no consequence because ultimately earnings are and will continue to do what earnings do?
This conversation has been anything but stable so far this year. Let's be clear about that. This conversation will continue on Monday. Here's the lineup for you. Greg Battle of BNP Paribas, BlackRock's Wei Li, Keith Lerner of Truist. We'll catch up with Citi's Veronica Clark. Looking forward to that conversation. Have a wonderful weekend for all of you at home. Equities right now rallying by more than 1% going into that opening bell. 34 minutes away. From New York City, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much more than a bookkeeper. I talk more about culture today than I talk about numbers. It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. We're going to count you down to the open. It's the slowest jobs growth in 6 months and a double-digit drop in twos. We're repricing the rate cut narrative. Countdown to the open kicks in right now. coming up. It was a downside surprise in the U.S. payrolls report, sending futures higher and Treasury yields lower. Apple announces the biggest buyback in U.S. history. We begin with the big issue, the jobs data in the USA. Let's get straight to Mike McKee to break these numbers down. It was a bit of a shocker on the downside surprise, and wages were lighter on their feet. Mike, good morning.
Good morning, Manus, and it's a good morning at 20th and C Street in Washington, where the Fed has to be happy about these numbers. Obviously, Wall Street is. 175,000, as you mentioned, the lowest in 6 months, and it's a big drop from 313,000, or revised 313 last month. Last month does seem to be an outlier. We also saw the unemployment rate rise a tick to 3.9%, but that's basically pushing it out to 3 digits. 0.02 of a percentage point made the difference here, as it was rounded up to 3.9. Average hourly earnings also a pleasant surprise. They come in lower than anticipated, 0.2% higher, pushes the year-over-year number down to 3.9%. The job breakdown is basically what it has been for months, with a few changes. Healthcare and social assistance, always the big gainer, 87,000 jobs. Retail, 20,100. Americans still spending and retailers still hiring. Transportation and warehousing, this has been a category that's been losing jobs, and now it's up 21,800. The biggest loser, administration and support. And we've seen in the layoff announcements that we've gotten recently that it's been these mid-level people who have been getting the axe at the corporations, who are cutting back a little bit. The Fed is, as I said, going to be pleased with this. The markets are going to be pleased with this. You look at what has happened over the last year, and you can see the blue line is the 2-year note. The white line is the Fed target. Fed hasn't done anything, but these numbers push the markets around. Just doesn't know what it's going to do, but it looks like its bet on holding steady is going to pay off.
Okay, Mike, thank you very much. Great roundup on the data. How does it transfer to markets? This is about repricing. Repricing from virtually no cuts to a rate cut now in September. Double-digit drop in terms of yields across the board. This is the 2 years, down by 11 basis points. It sparks a renaissance across assets, with equities flying higher. Yes, the job growth might be slower, the wage growth might be slower, and therefore the long variable lag may well be coming to effect in terms of the real economy. We've gone from 7 rate cuts to 0 rate cuts, and we're now potentially pricing up to 2. There's a sigh of relief in the Bank of Japan as that currency has rallied by 3%. Anne-Marie Horton is with me with a special guest from D.C.
Thank you, Manus. We welcome now to our TV audience and radio listeners. I'm Anne-Marie Horton. Joining us is Acting U.S. Labor Secretary Julie Su. Acting Labor Secretary Su, thank you so much for your time this morning. We've heard from the reports. The Fed would seem to be happy with this kind of jobs report. The market is certainly happy. It's this Goldilocks, potentially softening to have a landing of this economy, to a soft landing. What we're seeing right now with this softer report, and the market's certainly taking it in stride. Is that the consensus as well in the read from the Biden administration?
Yes, that's exactly right. This is another strong jobs report, and these numbers just keep showing us month after month that President Biden's economic strategy is working. It's everything you said. It continues to be strong, stable growth, sustainable growth as well. The unemployment rate is still under 4%. That's the 27-month straight that is the case. And the prime age labor force participation rate remains strong. It ticked up a little bit. And for women, it's the highest it has been since this number's been recorded, which was begun in 1948. So this is a strong jobs report that continues to be indicative of a very strong economy.
Well, this is what we heard from Chair Powell earlier this week. Quote, strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and the continued strong pace of immigration. How much do you see immigration playing into the supply side of this labor market?
It's all part of the story. You know, immigrant workers have, throughout our nation's history, helped to power our economic strength. At the same time, what these numbers show is that the jobs for native-born workers remains very, very strong as well. So when you have such sustained job growth, there is really, you know, it's beneficial for everybody.
Well, we do have a lot of immigration. The CBO, of course, looks at 2023 when they thought maybe it was going to be 1 million. Immigration actually at 3.3 million. But how do you match that supply to demand, especially if these are a lot of undocumented workers? How do we match the supply of potentially, are they going to the right jobs and the demand the U.S. labor market actually needs?
I mean, this is something that the Department of Labor is laser focused on every day, is making sure that we are connecting people to the good jobs that they want and need, especially in this moment of such historic job growth, not happening just by accident. It's happening because of the resilience of the American people, because of the small business boom that we're seeing, because of working people. You know, the president says all the time, it's the middle class that built America. Unions built the middle class because of strong growth for unions. And it's also happening because we are seeing people coming into the labor market. And so this is a moment where we have to be able to connect people to those jobs and employers to the people that they need. And that's why our workforce development system is so important, and why when I travel the country and I see training programs that are bursting at the seams, it's another indication that this economy is moving in the right direction and that Bidenomics is having a positive effect in communities all across America.
The survey response rate, though, for this report was 54.9%, the lowest, Julie, since 2002. How accurate, then, are these numbers?
Well, the Bureau of Labor Statistics remains the gold standard for reporting on unemployment, on job growth, on different industries. It is the largest body of data that exists. And let me just say, you know, the numbers tell part of the story. I mean, the numbers remain reliable. They remain, you know, what is relied upon to evaluate our policies and also to look at what new policies we should be pursuing. But the numbers are part of the story. The other is that the president promised that he would build an economy from the bottom up and the middle out. And in the last, you know, under his leadership, we have restored the 40-hour work week for millions of Americans. We are making sure that retirement security is something that all, you know, American people can enjoy. We are looking out for workers who've been left behind in the past. I've been in Uniontown, Pennsylvania, talking to mine workers who've had to be exposed to silica dust. I've met with farm workers in California who put food on our tables, but have to die in vehicles that are cramped without seatbelts. We are also addressing those issues, and so the overall numbers, again, are part of a story in which President Biden is delivering on his promise to build a strong economy in which everybody can play a part in it and see themselves having a secure future.
But back to this survey, that would put the standard error at 130,000. So it could be 305,000 or 45,000. Anywhere in that range is statistically accurate. How concerning is that, given this data is highly important, not just to the Fed, but also to the president?
No, that's right. I mean, the numbers are reliable. We continue to work on survey response. You know, people sometimes think, well, you know, the numbers get adjusted each month. What is that about? That's also very much part of what we do. It's what, you know, it's part and parcel of making the numbers as accurate as possible. So sometimes numbers come in later, and that's why we make adjustments. And again, you know, this is the gold standard for a reason, and we do want to continue to increase the response rate that we get.
I just want to end on the fact that wage gains are less than what was expected. And when we continuously poll the American electorate, they're not worried about jobs so much, in the sense that they're actually worried about inflation. And if the wages are not keeping up with inflation, how concerning is that to you?
So wage gains continue to outpace inflation. That means that there's more money in workers' pockets. This is obviously, as you say, this is a sign of how good people feel. And a good job changes lives, and a good jobs with wages that are enough to sustain a family are really important. And we continue to combat inflation and high prices. That's why the president's so focused on combating junk fees, on making sure that prescription drugs are affordable, and so it's a whole holistic approach to investing in the American people, and we are on the right track and will continue with the work.
Julie Su, thank you so much for your time this morning. Acting U.S. Labor Secretary, of course, Julie Su. Manis?
Anne-Marie, thank you very much. Great conversation there in terms of the rounding errors, as Anne-Marie just pointed out. The potential is for something up in the 300s through to 45, but a spirited defense by the acting secretary there. Coming up on the show, more on the labor market, the signs of a cooling.
We've had 27th straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No, but if the increase accelerates, that would really worry me.
Okay, BlackRock's Rick Reader joins me next to dig into the data.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
We've had 27th straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No, but if the increase accelerates, that would really worry me. Remember, especially at the low income side, wage are key to consumption and key to economic growth. Pandemic savings have been run down, credit card balances have been run up. So wage income is absolutely critical to the well-being of this economy.
Those are the concerns of Mohamed Al-Arian in terms of an acceleration in the unemployment rate. My guest this morning is Rick Reader, BlackRock Chief Investment Officer of Global Fixed Income. You should be sitting with a smile on your face, and you are. The bond market is like the hounds have been unleashed. Double-digit drop in yields. The bond market believes not only are rate cuts coming, Rick, on this softer jobs number, but they're coming earlier and potentially in more size. Are you joining the smile? Good morning.
Thanks for having me, Manis. So listen, I think it's amazing how markets, it came in the beginning of this year expecting 6, 7 cuts. Then it's like no cuts, and it's amazing how people revise their forecasts. I mean, now we're pricing in 2 cuts for the year. I think that's about right. In the listen, we still have to see the inflation numbers come down. But I'm pretty blown away by this number in a couple of regards. The symmetry, by the way, the 3-month moving average of job hires, 242,000. The 6-month, 242,000. And if you actually add up the last 2 months, they come up to 245,000. So it's pretty unbelievable. The economy is stable. But at the margin, and I think this is what's the big deal for the Fed, it is starting and hiring is starting to decelerate, and that is, that is a good thing. So listen, I think I've not said this a bunch. I think the Fed would like to get a cut or two in this year, and today opened the door for them to get that done. And but you still have to see some better inflation prints over the next several months. So we're going to be pretty focused on that.
Yeah, I mean, everybody's berated, the 3 hot inflation prints and telling us, it's not enough to establish a full trend. Here we are one day, one slightly lower reading on jobs, and we are quite literally off to the races. So let's dig a little bit deeper. You talk about the overall trend. Again, do you think that Powell, obviously, they said that he potentially had access to this data. He pushed back against the concept of a hike, and he sounded particularly dovish, and he was convinced that we were in restrictive territory. Do you think this is the beginning of understanding what the incremental impact of restrictive rates is?
So, yes. I mean, I would say a couple of things to that. One, I think the chair was very clear about the bar for hiking rates was extremely high. And I think that was a big deal for the markets. I think he basically took off the table that they're considering that anytime soon, and that you should just sit back and wait and see, and the data will start to move in a direction that allows them to start the cuts. I think that's a big deal for markets. Listen, and particularly in fixed income, people are sitting on immense amounts of cash. You see this in money market funds, you see it in deposits. And boy, anything that for the markets gives you some sense, okay, they're not considering rate hikes anytime soon. I can feel a little bit better about putting money to work, and the income levels you can generate are substantial today. So, your comment earlier about unleashing the hounds. I don't know about the hounds, but I think there are a lot of people who are saying, I just don't want to get bludgeoned by rate moving higher. And listen, I think when you look at some of these numbers, healthcare in today's number was healthcare and education 95,000, 175,000. So if you strip out healthcare and education, not cyclical, not interest rate sensitive to any significant measure, we're talking about an economy that is slowing a bit and allows the Fed to move. And then this gets people comfortable that, gosh, I can put some money to work, particularly at these yields that we haven't seen in a couple of decades.
Well, we haven't. Let's just talk about the yield moves today and this week. 2's down 11 basis points, give or take a tick. I need to refresh my price. Down 23 basis points on the week. 10's down 10, down 19 basis points on the week. Have you been actively deploying? Would you be an advocate of active deployment into this market this week? I mean, the ECI was just a couple of days ago, and we were freaking out with that. So just contextualize those kind of moves for me this week and today.
So I think there's something pretty spectacular in markets today in fixed income that is worth sitting back and taking note of. If you're holding income today let's say in the front to the belly of the yield curve, and then we talked about it last time on the show and the time before that, the yield is so let's say that rates stay here. Let's say rates move up a bit. If you can carry, in my ETF, we're carrying almost 7% yield. And you think about what that means. Every single month, I'm throwing off 55, 60 basis points of carry. So let's say rates move up a bit more. Gosh, it'd take you a month to work through that in terms of, because your income level is so high. So if you said to me, have we been doing things? Yes. Do I like owning these yields in this front middle? And do I like owning income, investment grade credit, some mortgages, some securitized assets, high quality assets? You could throw in a bit of high yield. Boy, this is, I've been doing this a long time, like for a decade or longer than that. You're saying like, I gotta own some risky assets because yields are close to zero. Today, you could feel pretty comfortable because your income and your carry is so substantial of holding some of these assets, and your return will be pretty hard, unless you think rates are going much higher, which is almost inconceivable given the moderate deceleration in the economy. Then you'd feel pretty good about owning that part of the yield curve. Longer in interest rates, tougher story. Do you need it with a curve this flat? I don't think you really need a lot of long interest rate exposure.
Look, the market has decided to put its stake down in the ground today. It's turned the page on higher for, I would say that the market has decided to turn the page on higher for longer and to reflect. Perhaps not just as high for not just as long. Is it too early to do that?
So, listen, I think you have to assume there's an extraordinary amount of, we're in this era of infrastructure spend, climate spend, AI spend, the energy that has to go in around it. There's a lot of capital that's got to come in simultaneously or be put to work to support this sort of CapEx and R&D spend in the economy. Secondly, you have a dynamic where if you look at these payroll numbers and you go back a ways and think about, why are wages this elevated? There's actually not enough people without immigration. Certainly, there's not enough people for the roles that are out there. So I think you have to assume that we're going to be at a higher, and by the way, the Treasury's got to issue an awful lot of debt.
Yeah.
So you've got to assume we're at a higher interest rate threshold than you've been at historically. But, it's also why you're seeing a lot of asset allocation. Every day I see this. People say, I own equities. By the way, I still think equities make sense. I own equities, but boy, I can create a bit more balance in my portfolio, clipping some income. And these yields are pretty attractive. I mean, if you think endowments, foundations, pensions, they have a return target in and around 7%. You had to get it through equities. You had to get it through alternatives. Today, boy, you can get it through some fixed income assets with not a lot of volatility, not a lot of beta to them. That's a pretty unique point in time.
I came across a lovely phrase from Bank of America this morning, so bear with me on this because I quite like it. Crashes in cocoa, corrections in crypto, and wobbles in gold. And the thesis is those bubbly assets of 2024 showing signs of a higher for longer stance is now percolating through the market. But you extrapolate that a little bit further. You talk about non-mortgage interest rate payments. So put your thesis to bubblicious. I mean, bubblicious could be blowing up according to Bank of America. You've got a slightly more intellectual take.
Oh, I don't know about that. But I would say, listen, I've done a bunch of presentations recently to show what's happening when you keep the interest rate this high. You're actually putting a lot of pressure on lower income. You're putting a lot of pressure on local banks. You're putting a lot of pressure on commercial real estate, small business. You have an economy that's very disparate today. You've got part of the economy that is a borrower that is really getting hurt, and you're seeing that when you look at the earnings reports. You look at the dispersion in some of the lower income, some of the small business versus some of the big business companies that don't have to fund themselves. Look at big cap tech that funds through free cash flow, buying back huge amounts of stock. Not at all really interest rate sensitive. So you have what is a two-part economy. And, you're witnessing part of why I think the Fed needs to bring that rate down over the next, certainly the next few months is, gosh, it is pressuring. And I think where Chair Powell is right in a lot of ways is there is some real restrictive behavior here, but it's impacting a part of the economy, and the pressure there has become pretty acute. And you're starting to see that in the numbers.
Do you think in 30 seconds, they must be mopping their brows and raising a glass of sake in Japan tonight?
Listen, Japan is a really interesting. I mean, the yen move this week is keeping me up during the night, to say the least. There is, it impacts rates markets. By the way, Japanese equity stories have been a pretty good story here, and how the central bank moves the currency is going to be interesting relative to that. But yes, stabilizing a currency that had a shocked move earlier in the week through 160 was has to feel a bit better. Obviously, a lot of intervention to get there, though. It'll be interesting how their policy evolves away from intervention, given what we saw last week or so.
Rick, thank you very much. Compressed and to the point. Thank you for joining me on Jobs Day. Rick Reader there. Morning calls a little bit later. We got PGIM's Michael Collins joining me around the opening bell to discuss the outlook for markets after this softer number on Bloomberg. love payrolls Friday. In theory, it's all going so well. Yields are down, double-digit drops on 2s and 10s. Apple is resplendent. Monster buyback, $110 billion, the biggest in history. The stock is up 7%. And they decry those China bears on their numbers. Look at this. Stocks are up over 1% on the SPOOs. But taking it away, it is tech as those yields drop. Tech is resplendent. NASDAQ up 1.5%. I can sing you the Goldilocks tune if you'd like to. But in the meantime, I will give you your calls. Bernstein downgrades Peloton to market perform. Moving to the sidelines on lingering growth and debt concerns. Morgan Stanley downgrades Estee Lauder to equal weight, expecting a muted sales recovery due to numerous macro headwinds. And finally, JP Morgan raises Apple to $225.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Pro-risk at the moment as yields drop. There's 175,000 of jobs growth. That's significantly less than the market had anticipated. Wages are tempered. And so the narrative changes about the timing and potential and the size of rate cuts. Equities are bid. Apple is up. Let me take you through the rest of the assets because the bid in equities in some and in many ways is inextricably linked to the drop in yields. You're looking at double-digit yield drops from 2s, and we've just come back a little bit in 10s, but I can assure you that on the week, you're looking at 2-year yields down by 23 basis points. 10s are down by 19 basis points. Rick Reeder was just with me there, which is, get on board here. The market has moved now. The long variable lag seems to be just snapping ever so slightly at this. 3-month unemployment, 242,000, or jobs created 242,000. They're breathing a sigh of relief in Japan. That is the dollar down and the yen up, strengthening by over 3 0.8% this week. So you are just looking at a strengthening in the yen as they unilaterally intervene, and many say it will not work unless you get G2 intervention. I mentioned Apple. Now look, the tech giant has announced the biggest stock buyback in US history of $110 billion and an upbeat forecast. Ed Ludlow is with me. So there's something of a misnomer here, Ed, isn't there? There's the Apple guidance in China versus the doomsday book scenario that we were given in the run-up to the data from Apple.
Yeah, and we are going to have to ask frequently throughout the day, like, what's the biggest driver in the stock right this moment? Is it the share buyback, the biggest in US history, or is it the narrative about the outlook for the current period in China? The stock's up 7%, on track for its biggest jump since November of 2022. The story all told was that in the quarter gone, things were not as bad as expected, though still bad. The outlook and potentially one catalyst in the stock this morning is that in the current period, sales will grow low single digits. That's what the CFO, Luca Maestri, told Bloomberg's Emily Chang. The specificity of China is that the iPhone is doing well. That is the narrative executive painted, but they called China an incredibly competitive market where everything else is not doing as well. The AI story wasn't really there. Next week, we have the Let Loose event, which is completely virtual. And then in June, WWDC. On the BloombergTerminal.com, go and look for yourself. Mark Gurman has kind of outlined the chronology of what's going to happen. Next week will be all about the next generation of iPad, a product line that's not had a refresh in 1.5 years, but did very well in the pandemic. And if you look at the earnings call transcript, that will be a driver of growth going forward. Then in June, we'll get the AI story. What does generative AI look like in the smartphone? But a $110 billion buyback, I mean, Manus, how often have you said the word buyback or dividend in the last 3 or 4 weeks? And how important is to the psychology of investors?
Okay, Ed, thank you very much. Yeah, it certainly was a fairly different story from what we thought we were going to get, and Wedbush Securities delivering their note. It's a turning point in the China story. Let's see. Turn to fintech. You've got Block revealing plans to invest a portion of their profits from Bitcoin back into assets. How's that going to work? Abigail Doolittle has the detail. Abby.
Yeah, it's an interesting mechanism, and I think that the bigger point here is that their buy now, pay later plan, that really has driven profits and revenues and should continue to do so. This, of course, after they merged Afterpay with its Cash App. They put up a 20% earnings beat. The revenues beat by 1%. Their fiscal year EBITDA also above the streets. Now, analysts really like the cost controls, the shuttering of some businesses, internal controls. Cowen saying that Block results right across the board are solid all around. Interesting, yesterday after the bell, there was an interesting shuffle with the stock to the downside. There were some reports about potential regulatory investigations regarding illicit transactions, but CEO Jack Dorsey said, no, that's not the case, and we can see this stock up about 6% into today, down 9% year to date, still down just a little bit, but making moves in the right direction for investors who are long Block.
Okay, Abby, thank you very much. Let's turn our attention over to pharma. Amgen soaring today. The CEO saying he's very encouraged by the early results from a study of the company's experimental obesity drug. Simone, this is like magic news when it comes to this GLP area. What have they got to say?
Well, this is a drug called Maritide, and it's actually not a GLP-1. It's called an antibody drug conjugate. So one piece of it works the same way as those GLP-1 drugs like Wegovy, like Zepbound. But there's another piece, an antibody part, that apparently may stick around in your blood, in your gut, longer and may help people who are seeking to lose weight keep that weight off. So the CEO saying very encouraged by those early results, increasing the probability of success of this drug to 75%. It had earlier seen 50%. In a February study, 14.5% of body weight people lost in about 12 weeks. That was the highest level. Some people keeping weight off for 150 days after stopping the drug. This has been extraordinarily positive for Amgen, seeing its biggest move right now since July 2009, and taking a toll as well on shares of Novo Nordisk and Eli Lilly. Manus.
Yeah, certainly Wegovy and Ozempic may have a bit of competition on the block. Simone, thank you very much. Simone Foxman there. Turn our attention to travel. Expedia missing its estimates, gross bookings, and cutting sales forecast for the year. Isabel Lee is with me. The detail, Isabel.
Hey, Manus, it's just a straight shoot down for Expedia. Shares are now lower by almost 12%, and it's really because of Vrbo. It's a vacation rental brand. Expedia was expecting a boost in profits from Vrbo because this would allow travelers to book across Expedia brands, but that migration is slower than anticipated, and this resulted in gross bookings and adjusted EPS to be lower than expected. We do have adjusted EBITDA and revenue to be higher than expected. Still, Wall Street wasn't happy with this. We have Piper Sandler downgrading the stock, saying that Expedia's booking growth is worsening and that margin uplift from tech improvements remain, quote, elusive. Price target now is set to 145 from 175. But, you know, they're not alone because bookings, its rival, is also having trouble. It said that room night reservations is expected to slow this quarter as tensions in the Middle East continue to curb the regional tourism that they have. Expedia shares year-to-date are lower 20%, and today it's down 13%, Manus.
Okay, Isabel, thank you very much, Isabel Lee. And joining me now is Michael Collins, Executive Portfolio Advisor at PGIM Fixed Income. Michael, good to see you this morning. These bond markets, just chatting to Rick there, Rick Reader over at JP Morgan. I was just speaking to Rick Reader. Look, double-digit drops in yields. This bond market really likes what it sees in this jobs report. Can that kind of momentum sustain?
You know, I think, Manus, that rates overshot over the last few weeks. I mean, if you look at what was priced in terms of the funds rate going forward, I mean, the low terminal funds rate really for the next 10 years was about 4%. Just yesterday, right? And that seems to me to be 50 to 100 basis points too high as a permanent location for the funds rate. So I think, like, typically, you know, because of human behavior, the markets overshoot on these inflection points. And I think the markets were pricing in, or have been pricing in, almost 100% probability of this really continuation of really strong growth, relatively high inflation, and a permanence of these really high interest rates. And I think that was overdone. So yeah, I think rates are going to probably continue to fall over the next couple of years, but they'll be choppy, right? Welcome to data dependence.
I mean, the debate is this. You know, today we've got a slightly hysterical response in the bond market, double-digit drops in terms of yields. That rolls on from the dovish narrative from Powell just the other day. I caught up with the Daimler Truck CEO. He's talking about order intake being strong here, and at the margins, he's maybe got to trim a little bit of fat off his production, but he's not seeing anything like a hard landing or a recession coming down the pike. So this is really perpetuating the sort of softish kind of landing narrative.
Yeah, we call it weakflation, right? Which is not stagflation. It's a kind of watered down version of stagflation, where growth just continues to moderate down toward 2%, maybe even a little bit lower than 2% over the next year or two. But inflation probably does stay above that Fed, target of 2, maybe for years to come. And again, that is not a bad environment, right? That's an environment, man, where the Fed probably ultimately has to cut rates, 100 or even 200 basis points over time. And again, the 200 basis points are not priced in, right? So I think ultimately the whole rate structure comes down a little bit. Growth doesn't, fall off a cliff. I mean, we have a very low probability in our different scenarios of a hard landing, and that's really driven by the bottom-up, fundamentals, as you pointed out. I mean, companies, the private sector writ large around the world, and certainly in the U.S., have been the stars throughout COVID, throughout the inflation regime, throughout the higher rate regime. I mean, they have adapted to these situations, and we're seeing profit margins not only sustain, but actually start to move a little higher. So it's actually been a really good story from a bottom-up credit perspective.
If we sit back as we go to the close of business today, Michael, the market will have heard a couple of things. No rate hike is the optimistic scenario from Powell. 2, the Fed put is alive. If I get something more than an incremental move in unemployment, we will act. And here we are today. Wages are a bit softer. Job growth not just as voluminous as had hoped. I mean, this is a very pro-cyclical risk narrative to close out the week, isn't it?
It is. I mean, it's I know you're throwing the term Goldilocks around a lot this morning, and it really feels like a really good backdrop for investing, you know, whether you're investing in fixed income, which we are kind of pounding the table on really with our clients and generally advising them to add to public fixed income and even to leg into the duration trade as rates kind of back up toward the higher end of the range. And we're putting, you know, kind of 4.5 to 5 as seemingly, you know, near the high end of the longer term range. So, but even for equities and risk assets, you know, you've seen credit spreads in the corporate and high yield market continue even after today go back to their new cyclical and year-to-date lows, and heck, maybe they stay at these tight levels for years. And you know, I've lived through a lot of these cycles, Manus, and we've seen, you know, periods where credit spreads stay low for years as you're in a relatively benign credit environment, and that's very well where we're heading.
But then, just very briefly, can I square off with that, because the proposition back to you from Adam Posen yesterday, who was with Danny and myself, said, you know, credit spreads where they are suggests that we are not at restrictive enough territory, which maybe plays more to the higher for longer than we're currently pricing today.
Yeah, I mean, financial conditions are easy. I mean, this reset in rates higher will definitely tighten financial conditions if they stay around these levels over time. So that is something that's worrisome. But I think it's not really a financial conditions story. I think, Manus, it's more of just a general moderation in growth over time. I mean, some of these jobs gains, you know, we're seeing basically, as Rick Reeder said, 220, 30, 40,000 jobs a month on average, pretty steadily for a year or two. And it's almost, you know, unbelievable. Like, where are these jobs coming from? Now, a lot of them have been government and healthcare, right? And as you strip those out, the real cyclical part of those job gains have been closer to the run rate of 100,000. So maybe that's just a sign that this economy does have a speed limit, right? And I think we've hit it. So I think moderation and lower growth, but not a hard landing, are in the cards.
Okay, Michael, thank you so much. That is Michael Collins over at PGIM. Coming up, we'll take a look at the health of the consumer. We've got an exclusive interview for you with Jim Rizzolio, President and CEO over at Host Hotels and Resorts.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
DOJ or other authorities.
Could face big
bigger challenge.
What's next? It was going to keep rating World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The health of the consumer is in focus as earnings season is in full swing. Host hotels and resorts boosting its guidance for the year and beating the estimates. Let's have an exclusive conversation now with the CEO. It is Jim Risoleo, the company's president and CEO. Excuse me, Jim, good to see you this morning. So we're trading down at Starbucks, we're trading down at McDonald's. They're not your average kind of client, but talk to me about how resilient, how strong and robust the upper end of the market is in your hotels, because you get some mighty fine ones in the family.
We do have some terrific properties. Thank you for having me today. It's a pleasure to be with you. We released earnings yesterday. We had a very good earnings print. I will tell you that the resilience of the consumer is very strong. We have 3 business segments, leisure, transient business travel, and group. Leisure continues to be strong. We saw leisure rates in the first quarter that were 52% greater than the first quarter of 2019. Business transient travel continues to improve. 5% improvement in business transient travel in the quarter. And the real strength in our business is group. Group is resilient, it's strong, it continues to grow. We picked up 500,000 group room nights in the quarter for 2024. So we're really excited about the way Host is set up for the balance of this year and going into 2025.
Well, look, I mean, that's a very clear trend that everybody's telling me about, but then we're all used to paying a little bit more. We understand there's inflation. We understand it's been tough for you to get the staff over these couple of years. The question is, are you still able to raise prices? Is there a resilience in the face of higher prices across those 3 segments?
Well, that's a great question. The business transient and group piece of the business are pacing up very nicely. Our total group revenue pace is up 7%. For the balance of the year over the same time last year, and that includes an increase in both room nights and ADR. What we're seeing with the leisure traveler, and we have a unique portfolio of assets. We have 17 terrific properties, and we cater primarily to the very affluent leisure traveler. We are still able to raise rates, but not at the same pace that we have over the last couple of years when we came out of COVID. I'll give you one example. We just reopened last July the Ritz-Carlton Naples Beach Resort that was closed as a result of Hurricane Ian. Our leisure ADR in the quarter was $1,500. So our leisure ADR at the Four Seasons Orlando in the quarter was $2,000. So clearly the affluent consumer is still prioritizing experiences over the purchase of goods. And, we have really good product and we provide very good service. So they're willing to pay the rate.
And this is what came through. I caught up with Sebastian Bazin, who runs Accor, some pretty high-end, similar kind of high-end, high-scale businesses to you. He said, Manus, the consumer is changing. They want more in hotel, they want more in resort. So therefore, what are you going to have to add on to the product? What are you doing to develop the product? Is that the next evolution for you, Jim?
Well, it is. And, a good example is our recent acquisition in Nashville. It's a 2-property complex. It's a 1 hotel and an Embassy Suites. New property. We just acquired it last month. And it's located right across the street from the Music City Convention Center. The hotel is differentiated. It has 7 F&B outlets in the property. It has a spa. It has a yoga studio. It has a incredible rooftop bar and lounge that offers unparalleled views of the Music City. In the Ritz in Naples, we added additional cabanas. We added additional F&B outlets. That is what the consumer wants, and if you give them the product, they're prepared to certainly prepared to pay.
I'm at the cabana in Naples already. Tell me this: you paid $530 million, $500 million. You used cash. Why did you trade in cash? And would rates have made any difference? Would lower interest rates have encouraged you to borrow money to do this deal?
Well, we're uniquely positioned in the world of lodging REITs. Our balance sheet is a fortress balance sheet. We came into 2024 at 1.9 times leverage. We're the only investment grade balance sheet in the lodging sector. We had the liquidity on the balance sheet. We used the cash. And notwithstanding paying $530 million for that acquisition, which we're delighted to get done, by the way, we still have $1.7 billion of liquidity, and our leverage ratio is 2.3 times. So we're well positioned to continue to be an acquisitive company over the course of 2024. Point of fact, we can acquire another $1.1 billion of assets and only take our leverage ratio up to 3 times, which is very much in the investment grade.
And are you in a hungry mood? Are you in a hungry mood to do more deals? Are you going to use the phrase bolt-on? Try and make the last couple of minutes exciting. Tell me you want to do something more than a bolt-on acquisition. Or are you interested overseas? Just give us a little bit of a lift of the hood in terms of what you really want to do.
What I really want to do is put that balance sheet to work and continue to elevate the EBITDA growth profile of the company. It will be domestic. It'll probably be in some of our major urban markets that where we're seeing a strong recovery. It may be an additional resort if we can find one that works for us. So we are really an open book when it comes to where we want to deploy capital. It's where we can get the best returns.
We've just had a jobs report in the United States of America, 175,000 jobs created, less than the market had anticipated. Wages are settling a nib lower. Have you got all the people that you need to hire? Is immigration good for your business? What's the message I walk away with as CEO of one of the biggest REITs? Have you got the staff, and do you welcome the immigration?
We always welcome the immigration, and we have the staff. We're fortunate that our properties are primarily managed by Marriott and Hyatt, 2 top-notch employers that make hospitality a career. So we were able to bring staff back on a lot sooner than a lot of the independent hotel companies.
Okay, Jim, we heard it loud and clear. You're ready to do more. Good to have you with us. I'm always looking for a bargain, so I'll be on the lookout. That is Jim Rizzolio, host Hotels and Resorts. We've had a little bit more breaking news. It's a feast of breaking news for you today between jobs. PMI's just crossed. Mike is standing by. What have we got, Mike?
Well, we're doing things backwards today, Manus. The main event was already this morning with the jobs report. Well, we've got 2 more numbers out. S&P PMIs for services and composite both come in at 51.3. That is up from 50.9 for both of them in the prior month. So it suggests there's still some strength in the economy, even if not totally reflected in the overall jobs numbers today. 20,000 people added on the retail side. Coming up at the top of the hour, we have ISM services, also late to the party, but we're going to watch that closely because the ISM manufacturing numbers went down on Wednesday. So let's see what happens with services.
Okay, Mike, thank you so much. Some pretty big moves across these asset classes today. Time for your trading diary, what you need to know for the trading week. This is what we got for you. ISM services coming up at the top of the hour, plus Fed speak from Goolsbee and Williams. Mike McKee sits down. Next Tuesday, we get the earnings from Disney, Uber results coming on Wednesday, and finally, the Bank of England and the rate decision next Thursday. Will they come off Table Mountain as Hugh Pill and made it in South Africa last summertime? Quick snapshot for you on risk. This is the equity market reaction function to the lower than estimated jobs report, which maybe questions some of the growth, but what you have is a reaction function to the lower rates, and Apple just barnstorming away with the biggest buyback in American history, $110 billion, and their data on China, less of a dip than the market had anticipated, up 6.83%. I want to reflect back on the impact of this lower than expected jobs report, jobs growth at 175,000, and you have wages rising by 0.2%. Now, the consequence of that was a real furious move lower in yields. We've given a couple of bips back in some of these markets. At one juncture, we're down about 11 basis points on twos, but there is no doubt about it. The market is moving forward from December to November and now to September, potentially for a rate cut. So the rates market is repricing a little bit earlier than was originally anticipated as we had a hot PCI report. That was countdown to the open for you this week from New York. The Bloomberg team will take you through the rest of this jobs day reporting and the movements on the markets right the way through to the close. From New York, a very good morning from me and the team.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can check us out at youtube.com, and you can search Bloomberg Podcast. That's where you'll find us. It's Friday. We made it. We're going to get a lot of economic data today. We had the jobs number a little bit weaker than expected. We'll break that down, and we're also going to take a look at Apple. Good quarter, but I think the news is $110 billion buyback. That is, A, it's a staggering number, and B, it's basically every dollar of their free cash flow that's forecasted for the coming year. They're going to get back to shareholders. How about that?
You like that?
I'd like that.
You like that.
And they raised their dividend by a very slight
You'd
nudge.
prefer a bigger
I would
dividend.
prefer a little bit more dividend. But anyway, we're going to break all that down with Anurag Rana from Bloomberg Intelligence. He's going to join us. All right, let's kick everything off here. We're going to get to the economic data, but let's kick everything off with John Tucker on a Bloomberg Business Flash.
All right, we are data dependent, so let's start with the data. This is the Institute for Supply Management, the Services Index. Remember, services, the biggest part of the U.S. economy, coming in lighter than expectations. 49.4. The expectation was for 52. And remember, anything that's under 50, that's the dividing line between contraction and expansion. So there you go. But the big data point of the morning, some cooling underway in the labor market. Employers scaling back hiring in April. The unemployment rate unexpectedly rising. Non-farm payrolls advancing 175,000 last month, the smallest gain in 6 months. Wage growth, that was less than expected. So we heard from more than a few economists saying this morning that that is a Goldilocks scenario. Not too hot, not too cold. Investors now betting on a Fed rate cut in September from November. And that adds up to risk on for the markets. The S&P 500, 58 points higher, up 1.2% at 5124 on the index. Dow Jones Industrial Average, 500 points higher. That's up 1.3%. And the NASDAQ 100, 323 points higher. That's up 1.6%. Information technology, that is the best performing industry group in the S&P 500 right now. Of course, that is home to shares of Apple, up 6% after the earnings report, after the close of regular trading. And I got to point out that the best performing individual stock in the S&P 500, those are shares of Amgen, the CEO, touting their experimental obesity drug as looking kind of promising at this point. Yields, we'll do that. I'll finish up with 2-year yields, 9 basis points lower, 478. The 10-year down 7 basis points. That is at 450. We check the markets for you all day long. And before I forget, we are brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. The rates are subject to change. You can learn more at ibkr.com/compare. Happy Friday.
Happy Friday, guys. Happy Friday. Happy Jobs Day. It's been quite a week. I'm Alex Steele alongside Paul Sweeney and John Tucker. I do have to point out that the S&P is still up 1%, but if you take a look at an intraday chart, it is a nice straight line down after we got that ISM services number, Paul, when you have prices paid higher, index slipping below 50, and that employment number coming in at 45.9 for the service sector, which does echo what we saw in terms of hospitality jobs and sort of the meager addition that we saw in today's jobs report.
Yeah, I think so. I mean, I think the labor market, we had a lot of guests on Bloomberg Surveillance, a lot of economists, and I think the consensus kind of is it's still a solid labor market, but just cooling. And that's probably all maybe the Federal Reserve might need to pull maybe a rate cut, well, maybe a little bit forward in the year.
And if we dot together all the things we learned from, say, bookings and Expedia, et cetera, the service economy is starting to slow. So let's get more with that. Anthony Nieves, he joins us. He is the ISM Chair Services Head. He is the Chair of the ISM Services Business Committee. Let me get that title right. So talk to me about how you understand these numbers. So services index slipping below 49.4. How would you describe that?
Well, what we're seeing here is a pullback in the leading indexes that comprise this composite index. Business activity, 50.9, that's down 6.5 percentage points. Still growing, But as you said, it's cooling. It's definitely pulled back some. New orders still growing 52.2, but down 2.2 percentage points. And the employment market continues to be, just as this index indicates, 45.9, down 2.6 percentage points, attributed to a combination of things that we've seen in the past ongoing. Either they can't find applicable workers for open positions, or they're controlling that labor expense. And the last one, supplier deliveries, continues to be faster due to waning demand as well as improved capacity.
So, Anthony, can you kind of give us some context here, because context matters? Give us a little sense here of the trend here in some of this services data.
That's a great point. This is 1 month. We've contracted here first time since December of 2022. We thought it might take a little bit longer to bounce back. It came right back the following month. Not trying to be the consummate optimist here, but again, one trend, we're just under the baseline. Based on respondent comments, they indicate that they see the next part of the year that it will be some improvements there. So we'll just have to wait and see how it trends out over the next couple of months.
Where are the worry spots within all the respondents? Where are the weak links?
Well, inflation is a big one. Pricing is definitely impacting their various industries and their companies that make up this sector, as well as the challenges in employment. Construction still seems to be an area where they can't backfill positions, and geopolitical issues as well also is on the forefront of our respondents' minds right now.
All right, great stuff, Anthony. Thank you so much. Anthony Nieves, I love that you hop on with us. We know you have a busy day. He's the chair of the ISM Services Index. Paul, for a while, you had that huge gap between ISM Services and ISM Manufacturing, and the whole conversation was, when does services come down to meet manufacturing? Then the conversation turned to, when does manufacturing come to meet services? And now it feels like maybe they are meeting in the middle. That all signals sort of a cooling economy.
Yep, absolutely. And I think, again, you're seeing that in the yield curve here. We have the two-year Treasury. It's down 7.5 basis points now. It was down. We're now at 4.79. We were at 4.70. So coming back just a little bit in terms of the yields here. Let's see where the action is in the markets. We have the S&P 500 that is up 1.1%. Carmen Reineke, she covers all the equity markets for Bloomberg News. She joins us here in our New York City studio. Carmen, what are you looking at?
Yeah, so I think the top story today really is Apple, ticker AAPL. Yeah, wow. Right now, shares are up 6.2%. This is a huge move for a company of this size. That's almost $150 billion in market cap added just in this jump alone. So the company had
the buyback.
Yes, yeah, exactly. Just a little bit bigger than that buyback. You're right. Yeah, so the company had sort of better than expected earnings, and really what the shares are rallying on, though, is this huge buyback, largest in the U.S. ever. Apple is, the top 6 of the largest U.S. buybacks, in general. So another record from the company here. I also think this is a big deal because Apple has really been lagging this year. This is just bringing us closer. It's still down about 4% on the year, but this is bringing us closer back to that even point. And yeah, definitely a good day for big tech. The next one I'm looking at, top performer on the S&P 500 today is Amgen, ticker AMGN. Yeah, shares are up about 13% right now. Its chief executive officer said that he was very encouraged by early results from the company's obesity drug. Yep, Maritide. Yeah, this is huge.
Where did they get these names from? What is it?
Oh my gosh, totally.
Maritide.
Yeah, but John, all you have to do is say, weight loss reduction. Yep. Boom. It's the AI of
totally
healthcare.
Right. Totally right. And then at some point you're gonna have to prove numbers and money and stuff.
Yep.
When does that happen? Anyway, so what did they say about it?
So they just said that they're very encouraged. I think what's interesting about Maritide is that you don't have to take it as much as the current offerings from Eli Lilly and Novo Nordisk. But you're right, this hasn't gone through the full process yet. It's not on the market. Also, something to note that both ADRs of Novo Nordisk and shares of Eli Lilly are down about 2% right now.
I always wonder with these things, Paul, is there like a first mover advantage, right? Like if you start it, are you going to really switch midway, or is there not the first mover advantage because you want to wait to be later but have like less side effects? Maybe it's a pill. Maybe you don't use it as much.
I think, just speaking from someone I know that's using it, they would switch if they could get less nausea, the side effects. They would switch. And if it could come in a pill, that would be a game changer. So I don't know. We'll have to see if people have any brand loyalty to this stuff, or if it's more just about
overall efficacy, I guess.
Yeah. I'm also wondering if production is going to come into play here, just because there have been shortages. If someone can get more product out to people faster, that's obviously going to be an advantage.
That's a great point.
Availability.
All right, let's
and
wrap up
pricing. I don't know who's paying for all this stuff. That's
we
a big
are.
one. Yes, we are.
In some form or another,
Yes.
through taxes. Expedia, just wrap it up for this one, because this one is nicely paired, I think, with jobs and the services number 2.
Totally. Yep. So shares are down 13% right now of Expedia. That's ticker EXPE. Gross bookings missed the average analyst estimate. It also cut its sales forecast for the year. So yeah, definitely not a great sign. Analysts noted weakness in VRBO, the online marketplace for vacations. I think it's also important to note here that the company announced in February that it's having a CEO change that's going to take effect soon. So Ariane Gorin will become the CEO May 13th. Succeeding the current CEO.
All right, so maybe people aren't traveling, but you know what they are doing? They're still going to concerts.
Yes,
Live Nation up 7%, having put this company together back in the day. It is just a juggernaut, and the artists are on the road like nonstop because it's the only way they can make money. They don't make money from selling records or streams or any of that kind of stuff. So the only revenue stream, and I'm talking even for like the Stones, this is their revenue thing, and people are still paying, and stock up 7%.
I want to see the Stones.
Yeah, I do too, but there's only stadium tours. I'm like, ugh.
I know, but that'd be super fun.
Yeah.
Maybe we should do a Bloomberg
You better
Intelligence
hurry.
road trip. Yeah, no kidding. But you could have been saying that for decades, and they're still
Exactly.
here.
I mean, have you seen
how Keith Richards
Yes.
is still going? Is beyond belief.
Isn't that the joke?
It is.
That Keith Richards is like, a cockroach in nuclear war, like anything,
Yep.
everyone else would die, but he is still there playing.
Yep.
I'm not calling him a cockroach, I'm just saying that he's everlasting.
All right. Carmen Reineke, thank you so much. We appreciate it. Carmen Reineke follows all of the markets for us, and we appreciate that. There's a lot going on out there in the marketplace here, and again, it's economic data, it's earnings data. Henrietta Trez joins us, Managing Partner and Director of Economic Policy for Veda Partners, I believe from Louisiana via Zoom. Hey, Henrietta, what do you make of this jobs report? I mean, to what extent is this labor market cooling in your mind?
Well, first of all, I have to just say, the Stones played last night at Jazz Fest down in New Orleans, so y'all just come on down.
Yeah.
Oh, fantastic. It'll be going all weekend, so can't wait. But no, the jobs number continues to be really, I think, just a Goldilocks moment. The market participants are focused on Fed interest rate cuts, and this reignited opportunities and sort of optimism for a Fed rate cut in September, which is a market difference from just earlier this week, and expectations for the last couple of weeks have been pushing it out till November or even next year, or even say that there could be a Fed hike. So I think this jobs number, while slightly lower than it has been in the last couple of months, continues this ridiculous trend of sub 4% unemployment, which is full employment in the United States, and really just paints the picture of a very robust, strong economy that is the longest running since the 1960s. So I think it's sort of a perfect number, to be honest.
How fast, though, can the job market cool? Someone pointed out on MLive, which is the great sort of blog that we do here at Bloomberg, that health and private education, excluding public school teachers, accounted for over half of the entire gain in payroll. So if you back that out, it was actually a lot weaker. And so I'm wondering how fast we can cool here.
I think that the ridiculous strength in job growth for the last couple of months, it's just been blowing out expectations. It's almost like, where were those jobs even coming from? It's hard to sort of wrap your head around those numbers so consistently for what is it, 24 months or something. I think that this jobs number reflects more of a reality. I saw on the same blog post, some similar comments about the weather over the winter period, maybe just bringing this back down to earth. And I think it reflects, a very strong economy that really doesn't have much room to continue growing jobs the way that it has been.
All right, so I guess when we combine this jobs print today, Henrietta, with what we heard from Fed Chairman Jay Powell earlier in the week, does this kind of alter the way you think about how the Fed may proceed for the remainder of the year in terms of perhaps cutting rates?
I don't subscribe to the theory that the Fed is politically motivated. I know a lot of investors are in that headspace, but I've worked with Federal Reserve folks for many years, going back to when I was in the Senate, and worked with many of the former Fed chairs, former Fed employees now. And I think the understanding that they are not a political animal is something that Jay Powell tries to relay over and over and over again, as he did on Wednesday. But investors don't necessarily all want to hear that. I think that if the Fed feels it needs to contain inflation, and keep its dual mandate going, they will cut as needed. I mean, one of the things that I'd point out is that we have elections in the United States all the time. Granted, they're only every 4 years of presidential election cycle, but we've got generals, we've got different elections across individual states, constitutional referendums. I mean, this happens all the time. So to assume that the Fed is somehow not going to cut from, July to November because the election, that's a big swath of time that they're just going to let the economy run unregulated. That's not really how they operate. And so I would just encourage folks to say, if they do need to cut, they will. And I think they'll do that X any political considerations. One more thing I'd add is that there's this view that if they don't cut in March or April or even June, then they can't come in and cut in September. I've heard that repeatedly from investors. And the idea being it'll look too partisan, too politically oriented. And I disagree with that, but it's interesting to see the market move since Wednesday and today's jobs report. Now they're all of a sudden pricing in cuts again in September. So it seems to vacillate quite a bit. And I just point that out because I think it's an interesting dynamic from investor perspective.
Yeah, I mean, even before this is already happening, they had that article last Friday, right, about potentially the Trump campaign talking about eroding that independence regardless. So there's that. Before I let you go, the way labor market slows, when could we be in a higher unemployment environment in this election cycle?
I mean, I think to your earlier point, it could happen pretty quickly. It's only at 3.9 now. It wouldn't take much to tick up to 4.1. And I think the revisions are something to watch, certainly, as well. And as we get into the summer months, you talked about school teachers. I think that there's opportunity for change, and I could imagine us being higher than 4% come election day, without question.
All right, Henrietta, thank you so much for joining us. Henrietta Tres, Managing Partner and Director of Economic Policy at Veda Partners. And just kind of looking at the market here, the S&P is up 0.9% off the intraday highs, but still moving higher, and the NASDAQ up 1.7%. Coming up, we're going to check in with Anurag Rana. He's a Bloomberg Intelligence technology analyst. He's going to give us the latest on those Apple earnings. And I think the takeaways, the $110 billion buyback, that gets your attention. Also, it looks like, after several quarters of negative revenue growth, they're guiding to a slight increase next quarter, and I think that's important for the stock as well.
And obviously China wasn't as bad as maybe it was expected, but I also have to wonder how much of this is Apple consistently kind of under-promising, over-delivering, which is something they've always kind of done, versus actual bottoming of the cycle and some real strength. And also then, is it June we get the developers conference when we are going to focus on AI?
That's exactly right. And Apple stock trading up higher here this morning, up 6.5%. We're going to have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are higher, but off the best levels of the session. You know what? I've been keeping a tally this morning, and we are up to 5 economists this morning on Bloomberg Radio telling us it is a Goldilocks report. Cooling underway in the labor market. The employers scaling back hiring in April. Unemployment rate did unexpectedly rise. You had non-farm payrolls advancing 175,000 last month. Smallest gain in 6 months. Wage growth less than expected in this report. So investors now betting on a Fed rate cut in September, moving that from November. And it was risk on for the markets. You had 10 of the 11 major index groups in the S&P 500 higher, with information technology in the lead, and that is where you find shares of Apple. Right now, most actively traded, those shares were up about 7.8% after the earnings report, after the close of regular trading yesterday. We did come off the highs after the ISM report at the top of the hour. That showed contraction in the biggest part of the economy. Maybe more importantly, prices paid a lot higher than forecast. S&P 500 right now, 43 points higher. That's up 0.9%. We're at 5108 on the index. The Dow Jones Industrial Average up 372 points. NASDAQ 100, 273 points higher. That is up 1.5%. The 2-year, remember, that was down, about 15 basis points. Right now, down 5 basis points again after the ISM survey. That is at 4.81%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alice.
All right. Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from the Interactive Broker Studio right here in Midtown Manhattan. You can also check us out on YouTube. We bring you all the news in economics and finance, and we bring it to you through our lens of Bloomberg Intelligence Analyst. They cover 2,000 companies in 130 industries worldwide. They've been doing it for decades, and they are really good at what they do. So on that point, we want to go to Anurag Rana, Bloomberg Intelligence Senior Technology Analyst, to give us the breakdown for Apple earnings. So we're looking at the best rally in almost 18 months from Apple. Stock is up by 6%. I should point out that the S&P is really starting to roll over. We're now up only 0.8%, so we'll see how long the rally in Apple lasts. But Anurag, what was the biggest standout that justifies the rally for you?
Yeah, when the results came out, I remembered a quote from late Charlie Munger that the secret of happiness and a successful marriage is low expectations. So I think this is exactly what happened with Apple, that, people going in were like so pessimistic that any bit of good news was just hailed with, the stock reaction that you're seeing right now.
So, Anurag, I guess before the print, you were talking about what you really want to hear regarding China and their business in China was stabilization. Did you hear that?
In fact, he said they were doing very good in China, which is contrary to every data that's out there. In fact, a couple of analysts asked him that, how do you reconcile with all this data on shipments being down versus your comments in China? He's like, I'm not responsible for them, but we are doing okay in China. So it's a big dichotomy right now in the market as to who to believe, whether the third-party data providers that are talking about a massive decline in iPhones versus Apple that's saying China is okay.
Did you like them spending the $110 billion on a buyback? I'm guessing you didn't, because Paul was into it.
No, actually, to be very frank, they spend over about 100 billion right now. So the 110 is a minor upgrade. The real news would have been if they said they're going to do about 150, frankly. So I think I know the headline number looks really big, but they do already spend currently close to $100 billion buying back, their shares. So I mean, I like it. There's no problem about it. But I think that's not really what got the stock going. The fact that they said that they're going to grow in, low single digits after about, around close to a 200 basis points, impact on FX, that's, I think, the biggest news at this point.
Hey, Anurag, I guess their developer conference coming up in June is going to be big for Apple. From an AI perspective, what will you be looking for at that conference?
So, I mean, my personal preference would be if they do a tie-up with Google and use Google's model to run some of those stuff. Because, there is a big unknown out there as to what's going to happen between their relationship with Google when it comes to the default search engine. And Google, supposedly pays them $20 billion for it. I think that's under a lot of regulatory scrutiny. If Apple were to refine and do another deal with Google where they can, mix both those things, it'll really help their AI costs, because I don't think organically they can do something this quickly. There are news by Mark Gurman that they're going to either tie up with Google or OpenAI. My preference would be if they tie up with Google over there.
So what is that risk for Apple from Google?
It is there, but to be honest, it's a 1 or a 0, which means there's no way to predict which way the judge is going to go. But I also feel that if this does come down to that, some kind of a legal issue, the two parties are willing to pay each other, or there is a transaction there, so they'll find another way to make it look less like that, a payment for default search engines, maybe per click, or there could be some economics there, but it is a headline issue, at least in the near term for Apple.
I have to say, Anurag, you do not seem that thrilled, or that you don't seem that thrilled after Apple's quarter.
No, that's not true. I mean, I'm very happy with the
You
results.
seem skeptical. Skeptical. How about that?
No, no, not at all. I'm relieved of what happened from last night. I just need to get to some of these 1 or 2 different things that are pending. Because, see, at the end of the day, Apple is one of the most phenomenal companies right now. There is nobody with an ecosystem that's stronger in the retail world or in the consumer world. But the question is, how do they get back to the growth rate, and can they get rid of some of the regulatory hangups right now? Their fees is under a lot of pressure, both in EU and perhaps even in the US. So there are a few things. It's not a clear-cut story as a Microsoft or an Amazon or an NVIDIA at this point. There are certain things that need to be cleaned up. But I'm always a big fan of Apple. Nothing about it.
All right, very good. Anurag Rana, thank you very much. We appreciate that. As always, Anurag Rana, technology analyst for Bloomberg Intelligence. In just moments, we're going to bring you a discussion. Bloomberg's Michael McKee with Austin Goolsbee, Chicago Fed Bank president, get his thoughts on some of this economic data. But I tell you, the Apple investors like what they heard yesterday. Stock's up 6% to $184. Not too bad.
Do we think that Austin Goolsbee is going to say Goldilocks? I don't know if he will.
I don't know if we're going to say that, but I mean, he could, certainly could. I mean, that's kind of what a lot of the data is kind of suggesting here, and the S&P kind of likes what's going on out there. The S&P's up a 1%, the NASDAQ is up about 1.7%, so some good moves there. Yields coming in, although not as much as before. The 10-year Treasury was in 5 basis points, 4.53% on your 10-year, 4.82 on your 2-year. That had been as low as 4.70 just earlier today. So right now, let's go to Austin Goolsbee, Chicago Fed Bank president, speaking with Bloomberg's Michael McKee on the economic outlook and this Federal Reserve. Let's listen in right now.
Welcome to the campus of Stanford University, the Hoover Institution's Monetary Policy Conference. And we're very excited this morning to have with us Austin Goolsbee, who is the president of the Chicago Federal Reserve Bank. Thank you for making time for us on a morning when all of a sudden the disappointments the markets had on Wednesday went away. Everybody's happy this morning because jobs came in lower than expected, 175,000. What was your reaction?
Well, I mean, 175,000 is a very solid report. Some of the root of our frictions here might be there's a kind of a day trader's timetable and there's an economic timetable. For setting monetary policy, of course, you got to take a longer arc view on inflation, on employment, and we're just trying to figure out, after the excellent dual mandate performance of 2023, let's call it, where inflation fell almost as much as it has fallen on record, and did so without a recession. How much can we continue that into 2024? We hit a bump for sure at the start of the year on the inflation front, and now everybody's just got to take a step back and try to figure out, is that a sign that the economy's overheating, or is that a sign of some other thing? The more jobs reports you get like this, where they're solid, but it's clearly moving back into something that looks like pre-COVID and conventional times, the more confident we can be that the economy's not overheating. But we just gotta watch this.
You are one of the, I don't want to use the word dovish, but more optimistic people about the possibility that rates could be cut this year. How do you feel now? We do see this slowdown. The ISM numbers show slowdowns. Spending numbers were lower than anticipated and lower than in the last quarter. Are we setting up to go back to the idea that rate cuts are going to happen this year?
I don't like committing, tying our hands of, even for the next meeting, much less when it comes to the fall and going into next year. I will say I was optimistic in 2023 that we could hit what I was calling the golden path, that there were reasons why, in an unprecedented way, we potentially could get inflation down significantly without having a big recession, which previous to 2023, that really doesn't happen. We did that in 23. As we're looking in 24, like I said, we clearly hit a bump at the start of this year, and we've just got to get comfort that it's not a sign of a re-acceleration of the economy. And we got some cross currents going. There's no question about that. I think what's happened so far in the job market this year is a little colored by, you got to take into account that we actually had significantly more immigration than we anticipated or than we thought at the time. So everything's got to kind of be normed to a per capita basis, and that makes aggregate numbers like aggregate GDP growth or aggregate consumption or aggregate payroll growth, you got to scale it down a bit, and we're still trying to wrap our head around how much.
What about the idea of the need to raise rates? The chairman was asked about it a number of times on Wednesday, said it didn't seem like something that was going to happen. Is it at all on the table for you?
Look, like I say, I don't like speculating when we're going to get a lot of information before the next meeting and before all the meetings for the rest of the year. In an unclear way, I say, don't think that nothing is never not on the table. You know, the job of a central banker is to be paranoid about everything at all times and to have thought through plans and how could we react to different circumstances. So it's not productive to say something's not on the table ever, something is on the table. I just think we're gonna find out these data, and the key element on the economic timetable, not the market trading timetable, is, are we continuing the progress, slow and steady, that we saw last year, or is some other thing happening that we're reaccelerating? The more jobs numbers like the ones we saw today, the more you see easing of inflation, the more comfort we would have. I would have on the committee. I don't speak for anybody else. And if it goes the other way, we'll react to that. You know, that's the Midwestern way. Is there is no bad weather, there's only bad clothing. You know, we'll deal with it. I mean, we're out here at Stanford. Hey, there's definitely no bad weather. But back in Chicago, you know, it's different.
Well, to drill down on that a little bit, the question then becomes, do you think monetary policy is tight enough? And if so, how do you square that with the idea that inflation has started going up again?
There's two separate parts to that. The first is, how restrictive is monetary policy? I think it's restrictive. I think if you look at the real federal funds rate, it's high. It's as high as it's been in some decades. And I think that lately, if you look at the interest rate sensitive parts of the economy, you see that restrictiveness. The second part of the question is, well, then what happened with inflation? And I think the answer, but that's partly what we're trying to find out, is there's a whole lot of other things besides monetary policy and besides the aggregate stated demand that drive inflation rates. And you've definitely seen things happening on the supply side of the economy. with shipping and bridges and canals shutdowns and things like that. Commodity prices, you've seen movement. Energy prices, you've seen movement. And so we just got to get a better, more comfort, I think, on this question of, are we on the long arc that we saw all of last year, and especially the second half of last year where inflation is steadily coming down, or are we in some different environment? And that's what we're
If you're in some different environment, is it things that monetary policy can affect?
It might be. You know, if it's all supply shock, probably not. I mean, we kind of saw that dynamic play out at the beginning of the pandemic when the supply chains shut down. So that's another important aspect that's in this effort. You know, as I kind of say, that everyone thinks it's a battle between dovishness and hawkishness, but it's not about the birds. It's the data dogs, and the first rule of the data dogs is know when to walk and know when to sniff. And the time to sniff is when we're trying to figure these out.
Well, when you look at the overall economy, we mentioned earlier that we're seeing some slowdown. Fed officials have said we can wait because the economy is in good shape. But how much do you worry that you're going to slow the economy too much? And because things like unemployment are a lagging indicator, that you'll find yourself with really slow growth or recession before you can react?
Look, that's the balance. You definitely have to strike that delicate balance. That's the dual mandate. And there was a time when the job market was explosively hot and inflation was well off the chart, in it worse than we wanted. And there's no balance in an environment like that. You're just trying to get the inflation rate down. If we remain as restrictive as this for too long, we're, in my view, definitely going to have to be thinking about the employment side of the mandate. So far, we've got some cross currents going. As I say, the job numbers today are solid. There's not in a previous world, if you said, you know, you're getting jobs numbers in the 175,000, 200,000 range, people be quite happy with that. So we'll just have to see. It is true that in normal times, when the business cycle turns the wrong way, it doesn't do so. It's not subtle. There's no subtlety about it. The unemployment rate goes up quite significantly. You see credit delinquencies deteriorate a lot. You see durable goods manufacturing, and other cyclically sensitive sectors deteriorate in a noticeable way. And you haven't really seen that, and that's part of where we're monitoring.
You have a manufacturing intensive district, but also a lot of services. What are CEOs telling you about their vision for what's coming and their planning in terms of employment and in terms of prices?
As you point out, the Chicago Fed's district is the most manufacturing intensive of all the Fed, and 4 of the 5 most manufacturing intensive states are in the district. Our business contacts on the manufacturing side, mostly they convey more of the same, that 2024, it's not accelerating, it's not decelerating, they're just trudging along in a decent environment. I think we still are seeing play out. We got past the supply chain bottlenecks. You don't hear a lot of input on that. But we're still in what you might call the consumer spending transformation, that in COVID, services went down, which normally doesn't happen in a recession because people couldn't go to the dentist and people couldn't go to the movies or see sports, and they shifted to buying physical goods. So the share of their budget that they spent on manufactured goods went way up, and we're shifting back. You're seeing that shift back, so that's playing out in manufacturing too.
Very quick last question, or 2 questions you can answer with a yes or no. The things people wanted me to ask you, was there any talk at the meeting of raising rates or about raising rates, and Did you have an advanced look at the jobs numbers?
Okay, you don't have an advanced look at the jobs numbers. You're going to have to wait 5 years to get the transcript from the meetings. The minutes will come out in a few weeks, so I'm definitely not going to say what people talk about. As you know, I never put anything on the table or off the table. I try to be as paranoid as possible about all potentialities and what could happen.
Very good dodge on that last question. You're auditioning for Fed Chairman. Austin Goolsbee, the president of the Chicago Fed, joining us today from the Hoover Institution's Monetary Policy Conference in Stanford. I'll send it back to you.
All right, that was our own Michael McKee out in Stanford, California. How good is that? Sitting down with Austin Goolsbee, Chicago Fed Bank president, getting a sense of what's happening in the Chicago district, the Midwest there, the manufacturing intensive area of the country, and getting a sense of kind of where monetary policy is going. And again, we heard from Fed Chairman Jay Powell yesterday that perhaps the hikes that some people were maybe concerned about, maybe that you can take that risk off the table a little bit. All right, let's get a reset of this market. We'll go to John Tucker and get a Bloomberg business flash. John, what do you have for us?
All right, guys, stocks are rallying, but off the best levels of the session. The S&P 500, 45 points higher. That's up 0.9%, 5108 on the index. The Dow Jones Industrial Average up 311 points, a rise of 0.8%. The NASDAQ 100 right now, 293 points higher. That's a rise of 1.7%. The S&P 500, you have 7 of the major industry groups higher right now, being led by information technology, and that is shares to home to shares of Apple. They are up 6.6% after their better than expected earnings report after the close of regular trading. Amgen shares, they are up 12.1% after the CEO touted their experimental weight loss drug. And then you had ISM services industry after the jobs report. That came at the top of the hour. That dropped in April to the lowest since late 2022. That accounts for pairing some of the earlier gains in stocks. And we check the markets for you all the time right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. I'm Alex Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio, where we bring you all the economic and financial news that you need to know with our great Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries. We also venture outside of that and talk to some really great investors who have their pulse on the market and can really understand how to position your portfolio for the next couple decades, really. Carol Pepper is one of them, founder and CEO of Pepper International. She joins us now from New York City. Carol, the market seems to be taking the report as Goldilocks. ISM services number might have put a little bit of dent in that, but either way, does this give you confidence to buy the market?
Yes, I mean, I think we're in a very nice sweet spot. I'm not necessarily one to buy the market. We look at sectors and see where the growth is going to be. So as you know, I'm a big tech bull. For the long term, I think you buy tech on fear days. And the United States really leads in technology and innovation and artificial intelligence. And those sectors of the Magnificent Six, if you will, out of 7, are really powering the market forward and will continue to do so. I think it looks likely that, the Fed will ease at some point this year, and that's very good for growth stocks. So I'm in a happy place with the report.
What did you make of that Apple print we saw last night after the close? What are your takeaways?
Well, I just think, again, it's, everybody wants to keep counting tech out because they missed the rally. And what I tell everybody is you can't time when all the good news will come in. So things are looking up for Apple. You just have to get in there, hold your nose if you're a value investor and you think everything's overpriced, because it's not if you have a long-term time horizon. As you know, I manage money for family offices, generally people with over $100 million, and we make long-term bets. And the long-term bet to make right now are the Magnificent Six. I leave out Tesla because I think they have a lot of problems. But if you look at all the other stocks, this is a good basket, or if you can't buy all the stocks individually, you can look at QQQ, get a broad base of American technology exposure and global technology exposure, and set it and forget it, and you will see continuing upside surprises. Sometimes we'll miss a quarter. Look at what Microsoft just did. They're reinvesting to buy more AI, so the earnings might be down for a quarter, but that is only going to translate into double the earnings 2 quarters later. So you can't just go, month to month and say it's up or it's down. You have to make some long-term bets if you want to make money over the long term.
So if I'm hearing you right, you're saying buy on fear big tech because it's a good value. Value plus tech.
Yes, it is the real value. The real value today is not the value stocks. The real value today are the big tech stocks because they have the balance sheet, they have the cash, and they're leading the entire country because their technologies will impact every single other industry in this country. AI is going to touch everything. So if you really want to make long-term money, if you want to fund your retirement or your kids' education, put money in tech and leave it there. Don't try to trade it daily. It's very hard to guess which quarter the earnings are going to pop up, when people are going to be more or less fearful. But when they are fearful, like they were a few days ago, that's when you jump in and buy.
So, Carol, what do you think about healthcare here? And the reason I ask is I'm looking at Amgen here. Here's a company with a $160 billion market cap company, up 12%. And it seems like in the healthcare space, if you could talk about a GLP into your portfolio, it's kind of like saying you got AI exposure and technology. It kind of works. How do you think about healthcare?
Well, I really think that healthcare right now is being driven by the whole weight loss craze because that is a huge trend that's going to keep going up. And I do predict that eventually, it might take another year, we're either going to get pills or we're going to get the price of the shots coming way down. And that will just bring a flood of new patients into the market. So that is a trend that you definitely want to jump on. I think for the next 4 or 5 years, at some point, the governments will put their foot down and start to mandate lower prices for these drugs. But for now, it's definitely a trend that will make money for you over the medium term for sure, because most of America is overweight, and this is a way to help them get their weight under control.
Yeah. Paul's hitting his belly at this current moment. Carol, before I let you go, what else do you like right now? What else do you want to buy on fear?
Well, I think the main thing is just, those are my favorite picks. I also think you should buy real estate, frankly, because real estate's going to come back. Again, you have to be a little bit patient. But if you're willing to sit through the summer, you can get some beaten up real estate development stocks and home building stocks. Real estate will come roaring back the second that the rates come down. The rates are going to come down. Do we know if it's 2 months or 6 months? We don't know. But we do know we're going to get there. So those of you who loved a bargain, look into the real estate sector right now. Look at home builders and people like that. That's really a place where you're going to be able to get in there early and pat yourself on the back when the rest of the world catches on your trend that you got in early.
All right, Carol, thank you so much for joining us. Carol Pepper, she's a founder and CEO of Pepper International, joining us from New York City via Zoom here. So I'm looking at this Amgen. That's kind of amazing. You don't think about Amgen as, but it just, they mentioned it. Boom, 12% move in the stock.
Yeah.
It's just...
What's amazing about these companies, though, too, is that a lot of them say the words GLP-1, and then they also deliver numbers.
Yeah.
It's not like they're just like, at some point we want to develop this drug. Like, these are real results.
What happened to the other side of that trade, which is people aren't going to eat Oreo cookies and things like that? Is that still a thing?
So remember that I talked to the Novo Nordisk CEO and an ed board, so that's where we bring a CEO in, and print and TV, we all sit down and we chat. And he said that he definitely had some of the snack guys calling him really panicked. Now, we asked the Mondelez CEO yesterday, Romaine and I, about that, and he's like, no, I feel pretty good about it. Like, people are still going to eat Chips Ahoy, that kind of thing. So I don't know. I really don't know what you do.
Interesting to see.
Because you really don't eat with that, right?
No, you do not. And I'm going to say it's just way down. So we'll have to see how it plays out. All right, we're going to have more coming up. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And I'm John Tucker, in the newsroom. Look at some of the company news we're following. Let's start with this one. The Securities and Exchange Commission accusing the auditor of Donald Trump's social media company of a massive fraud affecting more than 1,500 filings. B.F. Borgers CPA and its founder, Benjamin Borgers, will be permanently suspended from appearing as accountants before the SEC. They're going to be forced to pay a total of $14 million in fines to try and settle this probe. The SEC's enforcement chief says in a statement, and I'll read from the statement, Ben Borgers and his audit firm, B.F. Borgers, were responsible for one of the largest wholesale failures by gatekeepers in our financial markets. Big trial taking place. No, not that one. This is one of the most significant antitrust trials in 25 years, coming to a close in Washington. Federal court in Washington began hearing closing arguments yesterday after the 10-week trial in which the Department of Justice accused Alphabet, the parent of Google, of suppressing search rivals by paying tens of billions of dollars annually for anti-competitive agreements with the wireless carriers, the browser developers, and the device manufacturers. And Ernie Garcia II, Ernie Garcia III, they've added more than $11 billion in combined net worth since December of 2022. That's when Carvana stock fell below $4 a share, and the company was forced to restructure. These are the founders, by the way. That was then. This is now. The shares jumped 34% yesterday to the highest in more than 2 years after the company reported stronger first quarter earnings with revenue topping analyst expectations. The one-day surge pushed the older Garcia's fortune to $10.9 billion. And that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. Happy Jobs Day. I'm Alex Steele alongside Paul Sweeney. You're listening to Bloomberg Intelligence Radio. We are broadcasting live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us on YouTube. We want to get right to world and national news for you, and for that, we go to Michael Barr. Michael?
Thank you very much, Alex. Paul, John, one of the nation's busiest highways is completely shut down in a bustling area of Connecticut. A massive fire erupted when a gasoline tanker crashed and managed to severely damage an overpass on I-95 in Norwalk. No one was seriously hurt, but this could have a huge economic impact in the Northeast as it's shut down for several days. Former President Trump's criminal trial resumes this morning in New York. Jurors will probably learn more about a phone recording with attorney Keith Davidson about the alleged hush payment to Stormy Daniels. Yesterday on cross-examination, the defense suggested Trump was the victim of a shakedown by a lawyer steeped in tabloid tactics for celebrity stories. Donald Trump may be spending most days in a courtroom in Manhattan, but he's still focusing on winning the White House this fall. And this weekend, the next step is in his campaign. Bloomberg's Amy Morris explains from Washington.
Trump is sharpening his focus on a possible running mate by bringing top contenders for the job to an exclusive donor retreat in Palm Beach this weekend, along with hundreds of deep-pocketed GOP backers. Sources tell Bloomberg the short list includes Ohio Senator J.D. Vance, North Dakota Governor Doug Burgum, Florida Senator Marco Rubio, and South Carolina Senator Tim Scott. Trump's campaign says nobody knows when or who Trump might choose, and Trump has said he'll make his decision closer to the Republican National Convention in July. In Washington, Amy Morris, Bloomberg Radio.
Democratic Governor Katie Hobbs has signed the repeal of Arizona's Civil War-era near-total ban on abortion. Hobbs hailed it as a proud moment for Arizona compared to other states with strict abortion laws.
Today, we are doing what 23 governors and 55 legislatures refused to do, and I'm so proud to be the ones that got this job done.
Arizona still has a law banning abortions after 15 weeks on the books. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex.
All right. Thank you so much, Michael Barr. Here's a story that I just loved reading when I was on my way in. It's from the Times. Apparently, according to the Times, Dave & Buster's is going to allow betting on arcade games. Nice. So Dave & Buster's, you go, you play games, it's crazy, it's super fun, it's really expensive, you eat, you drink beer, it's great. Apparently, They're going to let customers bet on things like skee ball, billiards, and basketball shootouts. And a technology company, Lucra, is teaming up with Dave & Buster's to provide digital betting services. It has to be skill-based games because that's where you get the green light. There is a law that allows that to happen, that it has to be those that, you know, like tennis, golfers, that kind of thing.
The smart money would put money on me at skee ball.
Oh, I do skee ball.
Oh, we'll go head to head on some skee ball.
Oh, skee ball is my jam.
I learned skee ball at Jersey Shore, down at Mr. T's in Long Beach Island. That's where I learned my.
I learned mine at Rye Playland, baby.
Exactly.
This will be a Jersey versus Rye Playland kind of situation.
Well, that's so. I mean, gambling it's coming into all aspects of life. It just seems like the floodgates have opened over the last 5-6 years, and I've got all the. I mean, Michael Barr, you know this with the business of sports. It's just a monstrous business as it sweeps across the country.
And you hit the nail on the head, folks, about the skill part, because there was a question. And I used to bowl, and I was pretty good. And you know that you had to do pot bowling, and we call that. And there was a moment that we're going to suspend that, but because it was skill based, they allowed it.
Yeah, there was a professor that they talked to in the article from Baruch. A law professor says there's a carve-out in gambling laws that allows for people who are engaging in physical competition to compete for money in that competition.
All right.
All right, I think we're doing a field trip now.
Yeah, exactly.
Okay, let's do it. Dave & Buster's, Alex and Paul, skee ball. Need a little warm-up, though.
Yeah,
sure.
Yeah.
We have a lot coming up in the next hour as well. So stay tuned with us. More Bloomberg Intelligence coming up. We're going to talk to Tom Gimbel. He's founder and CEO at LaSalle Network. We'll talk more about those jobs numbers, what he's really seeing on the ground. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, folks, coming up in this hour, Tom Gimbel, founder and CEO of LaSalle Networks. We always check in with him on Jobs Day. He gives us a sense of what's happening out there in the jobs market. He has one of the largest hiring firms out there. It is Friday, which means we check in with Joe Misek and talk muni bonds. You're darn right we're going to do that. And then Geetha Ranganathan, she's from Bloomberg Intelligence. She is the media analyst out there on Wall Street, one of our go-to voices. What's happening at Paramount? Are they going to sell that thing? What's going to happen to MTV and, you know, CBS? I don't know what's going on, but we'll figure it out from Geetha Ranganathan. There's going to get a trade there at some point, I think. But right now, let's kick everything off with Mr. Charlie Pellet.
All right, thank you very much, Paul Sweeney. Jobs Friday. The Dow, the S&P, NASDAQ all ripping higher right now. S&P up 44, 5108, back above the 5100 level, up now by about 0.9%. We've got the Dow Industrials up 323, up 0.9%. NASDAQ up 266 for NASDAQ. The composite index up now by 1.7%. 10-year after the jobs report, 4.52%. The 2-year, 4.81%. Spot gold today, we do have the precious metal down $11 the ounce to $22.92, drop there of 0.5%, and a further retreat for crude, $78.53. West Texas Intermediate crude down 0.5%. This Bloomberg Business Flash brought to you by BNY Mellon Insight, June 4th to the 6th in Nashville, Tennessee. Don't miss the essential event for the financial advice community. Visit insight.bnymellon.com. Reaction to this morning's jobs report from Austin Goolsbee, president of the Chicago Fed, interviewed moments ago right here on Bloomberg Intelligence.
If we remain as restrictive as this for too long, we're, in my view, definitely going to have to be thinking about the employment side of the mandate. So far, we've got some cross currents going. As I say, the job numbers today are solid. There's not in a previous world, if you said, you know, you're getting jobs numbers in the 175,000, 200,000 range, people be quite happy with that.
Chicago Fed President Austin Goolsbee, interviewed by our Michael McKee. Again, recapping, stocks are higher. S&P up 42, a gain of 0.8%. The big stock story, Apple, it reported after the bell last night, shares surging now by 6.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. I'm Alex Steele alongside Paul Sweeney. We made it to Friday. We made it through Jobs Day. We made it through the Fed. We made it through earnings. We did a lot this week. There was a lot happening.
Yeah, hour 25 radio. So
excellent,
for the
excellent.
Week.
I mean,
good stuff.
Okay, such a slacker.
I think the Fed was kind of the forefront here with some of the data, but we also had some pretty solid earnings. And again, I'm still looking at that Apple print, looking at all the free cash flow that they deliver, and looking at the $110 billion buyback.
Or what is just an expectation game? So we're going to break down all of the fun movers right now with Norma Linda. She joins us from Bloomberg News, and you're starting with Apple. Walk us through some of the numbers here. The expectation game, it's hard for me to get away from that one, too.
For sure. I mean, of course, this is the big news of the day. As you mentioned, that buyback is really in focus. With that being its biggest buyback in history. And of course, we are seeing shares up around 6.8%. The company is seeing its best day since 2022. Revenue did fall about 4.3% to $90.8 billion for the first quarter, but that's still better than the Wall Street estimates of $90.3 billion. And of course, investors are not only focused on that buyback, but they're also focused on its upbeat forecast. And we know that this has really been, the stock has really been seeing a bit of headwinds. This comes after it posted sales declines in 5 of the 6 past quarters. So investors are really excited and hoping that this is a turnaround here.
All right, good stuff for our good friends at Apple. A lot else going on out there. How about Expedia? People traveling?
Travel. I'm looking at Expedia on the downward side. It's plunging for its lowest level in almost 6 months. We've got shares down as much as 14%, and now this is coming after its gross bookings missed expectations. It's not seeing as many people booking its services, and it cut its sales forecast for the year. That's not at all what you want to hear as an investor. We have analysts calling out weakness specifically in Vrbo. That's its online marketplace for vacation rentals. Not sure if you guys are familiar, but I've heard lots about it.
Oh, yeah.
And Piper Sandler said that its bookings growth is worsening and the margin uplift from tech improvements remains elusive.
Yeah, it's also interesting, the macro read on that too. Like part of it's competition, right? And also how people are maybe vacationing are different also. But I don't know, you pair a lot of different things like booking, for example. What was your sort of takeaway from those two together?
Yeah, I mean, of course, when you put those against each other, you have booking on the upward side, and it actually did have its gross bookings beating expectations. It saw gross bookings of $43.5 billion against the street's estimates of $42.2 billion, and its results largely beat across the board. It saw revenue of $4.42 billion against estimates of $4.25 billion. JP Morgan said it continues to see resilience in demand, especially as it heads into the peak summer travel. I don't know if you guys have a brand affiliation, if you actually use Booking or Expedia. For me, I know that my parents use Expedia, and I'm more of the bookings person.
Oh, interesting. What does that mean?
I don't know.
What does that tell us?
That's why I was curious that you guys could weigh in and give me some
okay. Paul definitely doesn't
context.
use any of that stuff.
No, well, the ski trip with the Summit dads, our guy, who is one of our dads, he uses Vrbo to get our condo.
Okay.
And that works like a charm.
Okay.
Yeah.
I heard that one's beautiful.
So I do many different things.
Okay.
When I have a lot of miles, I go right to the airlines. Makes sense. When I'm out of miles, then I go to like Rakuten and things like that to see what companies are offering cash back and how much.
Wow,
that's
and
smart.
then I'll go
She's a
to
process.
like Priceline or Bookings or Expedia or Travelocity. I'll go to any of the ones that have higher cash back, and then I'll book through them.
That's smart.
Or if my Amex card has like bonus points, like you get cash back too or whatever, get $250 off if you book here, I'll go through there.
Then that's where we go. See, because Booking, I know I had a friend and we went on a trip and she booked a hotel just to find out that the booking never went through. They wouldn't honor it, so it's given me a bit of pause when it comes to booking.
Well,
Maybe I have to
They
gravitate.
wouldn't honor it, really?
They wouldn't honor it.
Okay.
She would have been stranded.
That's highly upsetting. Before I let you go, if you're booking, maybe you're also going to a concert. I don't know. Live Nation did really well.
Yes, Live Nation is doing really well. We are seeing its best day in exactly a year, rising as much as 8.7%. Now it posted record sales. It seems that everyone's looking for concerts. Its revenue was $4.42 billion, and that was against estimates of $4.25. So just a slight miss, but we are really seeing some of an uptick when it comes to demand for concerts here.
And the largest shareholder is Liberty Media, John Malone. Yet another winner for John Malone and Liberty Media. It's pretty solid. All right, Norma, Linda, thank you so much. We appreciate that. Good movement in the market here. Good sense of where this Federal Reserve may go next, and that might be a little bit on the on cutting side here. So but let's get back to that labor data, because that is certainly the big play here for the markets here. We always like to chat with Tom Gimbel. Tom is the founder and CEO of LaSalle Networks. Tom, talk to us about this number here. A little bit a slowdown in hiring, but still a pretty healthy number. What's your perspective?
I'll tell you, I'm not sure that it's not actually a better number than people think if you look at how small the government hiring was.
All right, break it down for us.
So government's been averaging about 55,000 jobs a month. This month it was 8,000. So when you look at the percentage of non-government jobs added, this was one of the better months.
Interesting.
Because
I hadn't heard that.
So then why is the rhetoric like, ooh, if you back that out, the overall number wasn't that great?
Oh, because economists are depressing people. I think that in reality, as we talk about every week, adding jobs is better than losing jobs. So the economy is good. I think where we have a problem that everybody knows about is inflation. And for some reason, we've got cost of things going up, stock market going up, but it's being driven by the Magnificent Seven and all that good stuff. And then we're sitting here looking at people working, and the labor market is healthy. Now, what we're seeing is a lot of the jobs are in healthcare, and they're in hospitality, and they're in construction. And so those are a lot of hourly jobs. They're not the highest earning jobs, and we're seeing a little bit of white collar stalling in the hiring side.
So, Tom, it's early May. That means kids are going to start graduating from college. What's that job market look like?
It's there. It's there. It's just not as healthy as it was. And what I mean by that is the jobs aren't going to be, if you want, a lot of kids, I want to work remote, I want to work from here, that you're going to have to go into an office, I think, for a lot of the jobs, number one. Number two, the salaries aren't going to be as high starting salaries as they have been historically for recent college graduates. And number three, you're not going to see as high a volume of hiring at companies. So you might not get the company that you want or the job you think you want, but there are jobs available.
What sectors do you still feel like are pretty strong? I anecdotally was speaking to a friend of mine who's pretty high up in the tech sector on the data side, and she is just like, it's really hard to get a job. And there have been so many rounds of layoffs over the last year and a half or so that there's just a plethora of people trying to get in on the same jobs at this point. Where are the jobs? Where are they not? Talk us through all the dynamics.
Yeah, so I think the real challenge is where I think things are going to move over the course of the next couple of years is less industry and more skill set, meaning technology might not be hiring, meaning big tech companies, but people who do sales may be getting hired, and people who do development or product may be getting hired, but they're not hiring in marketing or HR. So I think it's more of what your skill set is versus the overall industries, right? So healthcare may be stalling. The nurse shortage isn't what it was 3 years ago. However, they're hiring a ton of doctors, and they're hiring a ton of medical records people as they move to AI. They still need to get the work done. So it's really in the roles versus the industries. But if I could wave a wand and give myself a skill set, it would be in security, in technology security. You guys see the hacks that Microsoft had a couple months ago, and there's a new one every week or every month coming out. And if somebody is really talented in the cyber security space, that ain't going anywhere.
Hey, Tom, I wonder from your perspective how the influx of immigrants, legal and illegal, into this country, the surge it's been, how's that impact? A lot of folks are saying that's been a net positive for the labor market and the economy. What do you see from your perspective?
I don't necessarily see that yet. So I think on the legal side, the problem with the layman, as you guys know, is people think that coming in is purely south of the border for immigration, and legal immigration is people who want to get married or they're just going to move here. We educate. There's different laws for non-citizens to come into the country to be educated at a lot of our best schools, and then you have to leave after that. And so the legal immigration of educating people and then not allowing them to work here, especially in technology fields and engineering, the STEMs, right? We have this population, we educate, and then we send away. It's almost a non what this country was built on methodology. And then number two, on the illegal side, I think the negative on the workforce isn't that we don't need people at an entry level and blue collar skill set. It's a matter of how it's affecting society and what businesses want to do, and people being scared and where things are at, and it overloading the system on some social issues, and that has ripple effect into corporate America. That's my concern. And then the last thing, it's the third rail, right? But I think I was doing an interview the other day about how we're seeing an influx from our clients at state schools doing finance and consulting recruiting because they don't want to just touch the Ivies with a 10-foot pole.
Well, that's really interesting. What's the why there?
No, I think there's you have a smaller student population base at the Ivy Leagues. So companies don't want to spend their time trying to look at social media and figure out who's in the protesting, who's not, who might have been abusive to other students, who wasn't, right? It's easier to say, you know what, we're not going to discriminate against people within the Ivies. We're just not going to recruit from the Ivies.
That's really interesting.
Tom, so what's kind of your view here as it relates going forward in terms of how do you think this labor economy is going to evolve for the remainder of this year?
I think it's going to continue to be fine. I think what we have is, this intersection, this Venn diagram, if you will, of where it meets of the overall stock market, a change in Washington, D.C. with the election, potential change with the Washington, D.C. with the election coming up, and then just where we're at with inflation and things like that, and interest rates. And so what we got today is, to me, it doesn't seem like the Fed's going to lower rates. And if that happens, I think the status quo continues. And I think it's going to be just this emotionally purgatory world we're going to live in for the next 6 or 8 months.
Okay, but let's game that out. So that's the Fed not cutting rates. If the Fed does cut rates, do the companies and industries you talk to, how would that influence their hiring?
Oh, it really depends, right? 25 basis points, not that much. What it does is, what it'll do is, if it has the desired effect that a lot of people in corporate America think, which is send the economy back into a hyperdrive state, then they'd continue to, the theory would be they'd continue to lower interest rates. And then when money got cheap enough, you could hire people in the classes of 20, 50, 100. But I don't think 25 basis points in the next or two sessions from now is going to all of a sudden turn 300 or 400,000 jobs a month. I don't see that happening.
Hey, Tom, is there any regionality out there into the hiring market? I'm just guessing, Texas, Florida going crazy, but is there any regionality out there?
No, I think you're right on the red states. We continue to see Nashville. We continue to see Birmingham and Alabama and cities like that, and the Triangle in North Carolina just being a hot sector. But no, I think other than that, I do think you're starting to see a little bit of it move in from the coasts, and I just think that's more of social issues than anything else. So it's where companies will go. I mean, look, I read an article. Don't quote me on it, but that Goldman Sachs has more employees in Salt Lake City than they do in New York. So I think that tells you that second and third tier cities are definitely a place where corporate America is going.
And we're going to Nashville.
We are going to Nashville.
Yeah, I'm super excited. I booked my hotel and I booked the airfare.
Okay.
So this is big for me.
Water slide to die for.
Water slides?
Yeah. Oh, it's a water park.
Aren't we a little too old for that?
Oh, no.
We go.
Water
we go
park.
to this. Okay.
Big,
there we go. Bloomberg Intelligence on the road from a water park. I don't know. Tom Gimbel, founder and CEO over at LaSalle Network. Thank you so much. We really appreciate all of that for you. But that's so interesting. It's like, when you stay on the West Coast or the East Coast, you forget that there's a lot of building happening, particularly in red states, particularly from some of the infrastructure bills that we've seen. And irrespective of that, there's still a lot of build out as well. So that's actually quite interesting. Speaking of regional, we have Munis coming up.
Darn right we do. It's Friday.
Damn we do.
Boom.
I missed it last week.
Oh, man.
I now feel like I'm starting to get into it. Let's not overkill it here, but you know, something's happening. Joe Mysick will be joining us next. He's editor of the Bloomberg Brief Municipal Market. He's going to get all of that data for us as you're taking a look at an S&P here that is up by 0.8%, but definitely off its highs of the session. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are higher. We are on track for a winning week for the S&P 500 index. And this Bloomberg Business Flash brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Stocks higher across the board. Wall Street taking a slowdown in the jobs market as an indication that the Fed will be able to start cutting rates as early as September, with traders sending stocks up sharply as bond yields fell. Right to the numbers. S&P now at 5108, up 44, up 0.9%. Dow Industrials up 357, up 0.9. NASDAQ up 258, up 1.6%. 10-year at 4.51%. The 2-year 4.80%. Spot gold down 0.4%, down $8.50 the ounce to $22.95. West Texas Intermediate crude below $79 a barrel now, $78.35, a drop today of 0.7%. Amgen shares soaring by 12.7% after its CEO said he was very encouraged by early results from a study of the company's experimental obesity drug, Maritide. CEO Robert Bradway saying, quote, "We recognize the significant interest in obesity." Again, Amgen up now by 12.7%. Recapping, S&P at 5111, up 47, a gain there of 0.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus with Joe Mysak.
All right, Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of building America. Invest in BAM.
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 Short
Bam.
bonds.
Bam.
There you go. We're all getting into it. Our good friends at BAM, we appreciate that. Joe Mysak joins us here in our Bloomberg Interactive Broker Studio. He covers all the municipal bond market since like the beginning of time. He's here. Hey, Joe, I think we got some issuance out there, right? The bankers are making money. States are starting to go out there. Talk to us about the new issue market for the municipal bond market.
Oh, man, we had a good first third of the year. Issuance is up about 30%.
Nice.
Wow. We have about, now, of course, it's the muni market, so I'm talking about, 143 billion. So it's not like this tremendous amount.
We'll take it.
But in munis, that's a big year and a big first third, and probably headed back toward in the 400s. A kind of remarkable thing that we found was that in the first 4 months here, we had 20 deals of $1 billion or more. And now this is, again, in your corporate market, $1 billion deals are relatively common. In the muni market, they're rare. So we had 20, and the record for a year was a couple of years ago. There were 26. That was for the year. So
what do you make of that? Like, what's the reason?
Well, it's the usual suspects, but there's a couple of more of them that are coming in. So big states. California had a couple on there.
Are these refunding, or are they the new issuance, or like new projects?
Some are refunding.
Okay.
Some are new money, and it's refunding. That's a nice thing you pick up there on refunding, because it actually came back this year. Nice. Because rates dropped. Compared to last year where it was choked off because the Fed kept raising. So we've seen refunding come back. So we've had some big deals, which is very, I would say it's heartening, certainly for the underwriters out there, because they get paid more on your bigger deals.
And how's the demand out there for these bonds? The new issues like the Los Angeles School District, I would think that's a really good bond. I mean, lots of tax base there, obviously, in Los Angeles. What's the demand like out there for new issues?
We're seeing, I would say, very good demand. And yields really haven't gone up all that much. They've been rising slowly, so it's relatively slowly. So in 10 years, what do we have, about 270 now, and so that's up maybe over the beginning of the year, maybe 30 basis points or so. So it's been very, very gradual. For the longest time, it's just, outright flat. So that really, shows you that the demand is out there for bonds. And, we're actually in April and May are not big months for money being returned to investors. But we're heading into a time, June, July, August, we see a lot more money coming back to investors. So, of course, demand is going to be even enhanced.
Talking about Texas. So apparently, Texas Attorney General staff met with some Muni Finance executives from RBC and Wells Fargo. What's up? What's going on with that?
Well, that's a nice scoop by Danielle and Amanda earlier this week. They're sitting down and they're talking to the banks, which I don't know. I find that good news. At least they're talking to the banks about this, whether their firms boycott the oil industry and other ESG silliness.
What does that mean? What is it? What is it? Boycott oil, ESG silliness.
They have a list. They have a little list of banks that they don't want to allow to underwrite municipal bonds if they boycott the oil industry, or if they
firearms industry
if they pay lip service to ESG.
So they won't do business with them,
right?
If they don't do business with them, basically.
Yeah.
Sort of.
So a lot of major New York investment banks are barred by the state of Texas from participating in underwriting their deals. And Joe's reported, and his team have reported on this in the past. If you have fewer underwriters bidding for your business as a municipality, presumably you're going to pay higher rates.
Yeah, cross go up.
So there's a cost to that. But
and you won't be able to sell those really big billion-dollar transactions because if you're depending on your small firms, you have to break up those deals. So instead of a billion-dollar deal, you'll sell several $300 million deals. It just seems to me very silly, self-defeating. No reason for it. But
all right, so we'll see how that plays out. That's again, I always like to say, it's Texas. They can do whatever they want. They're Texas. Right. They're big. How about Brightline? This is the company that's building for-profit railroads. I know in Florida, and then maybe even one from LA to Vegas.
Right.
Which got me interested.
Oh yeah. The LA to Vegas, I think they broke ground on that just last week. But the Florida one is, as somebody said the other week, I want to be skeptical on Brightline. I said, fine, you can be skeptical on Brightline, but in Florida, it exists. It is running. It carries passengers every day. So what they did was they sold a big refunding deal a couple of weeks ago, and Martin noticed that those bonds had gotten quite a nice little pop. But I always say, don't call it a rally. This is the way the muni market operates. The bonds are sold to primarily institutional investors, and then they flip them.
What's on tap for next week?
What's on tap for next week?
What's floating your boat?
Wow, I don't know. We're going to see, more volume come in, and I know that Augusta, Georgia, right? Augusta is
they
selling.
have golf there, right?
They have a golf course.
Yeah.
They're selling bonds for a new arena, $250 million deal. So that's kind of interesting.
Interesting. All right, I'm looking at the Bloomberg Municipal Bond Index, down 1.39% year to date. What's been going on there? I know that just following the Treasury market here.
Yeah, returns. Yeah, just not no. But you had this interesting jobs data today, so perhaps we'll see that turnaround.
So Joe, we were talking before, when I take the Jersey Transit train every day, I see this huge construction project going on outside the Lincoln Tunnel, building some new railroads and new access to various bridges and so on for the Gateway project, long-awaited Gateway project. And it just seems like I could just see billions and tens of billions of dollars being spent there. Is that federal and state and local? Is there a municipal bond component to that?
Oh, yes, indeed. The states had to come up with, a big chunk of change on that. And the federal government, provides, some money too. But it's a very kind of cooperative venture.
Yeah, and I'll tell you what, I told you, they are making unbelievable progress there. I mean, every time I go out there, it's like, boy, they added like another mile to this huge elevated train line thing. I don't know what the heck they're building. So
no standing around?
No standing around. Everybody's
Drinking
working.
coffee.
They're building across some river or lake or Hackensack, something like that. John Tucker knows all this stuff. So they've got boats out there with big cranes on them and stuff like that. So your tax dollars at work, I'll tell you that. Guess what, Joe?
No, wait a minute. That's it?
That's it.
Oh.
Joe
That's it.
Mysek there with your municipal bond overview, which we do every Friday. Why? Because it's sponsored. That's why. We love municipal bonds. I love me some municipal bonds.
You do. He really does.
You can check my portfolio.
Your ability to talk about municipal bonds like you do media is stunning.
You just
to
light
me.
up. Yeah, you
it's
just light
stunning.
up. And now my taxable yield is just ripping here.
Yeah.
So anyway, Joe Mysek, editor for Bloomberg Brief, covering all the municipal markets for Bloomberg here in our Bloomberg Interactive Brokers studio. S&P 500 up 1%, NASDAQ up 1.8%, 30-year Treasury about 4 point, the 10-year, about 4.51%. WTI crude oil, $78.65 a barrel. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, Charlie. A vital East Coast transit route is closed. A bridge in Norwalk, Connecticut is being demolished, and it is backing up traffic on Interstate 95. A gas tanker was involved in a multi-vehicle crash yesterday and burst into flames. Norwalk Fire Chief Stephen Shea.
One car cut off a tractor trailer. The gasoline tanker swerved to avoid it and ripped open the back of the gasoline, went down the road. He ended up stopping under the bridge.
Fortunately, no one was hurt. Officials say the closed section of I-95 could reopen by Monday. Governor Ned Lamont.
I know what an incredible inconvenience this is for people, and all I can ask you to do is stay away from that area as best you can. The traffic jams are horrendous.
Some local schools are closed today. Donald Trump said he would take the stand at his criminal hush money trial in New York, and then yesterday, the former president falsely claimed that a gag order would prohibit his testimony. The judge told Trump this morning that he has the right to testify if he wants to. Before walking into the courtroom today, Trump spoke to reporters in the hall criticizing the judge.
We are winning this trial. If we had a fair trial, if we had a fair judge, I don't think it would have even allowed this trial to take place.
More testimony is expected today. Former Trump aide Hope Hicks has been called to testify. She was one of the former president's closest confidants. Police moved in to clear an encampment at New York University this morning at the request of school officials. The latest development, weeks of pro-Palestinian protests at college campuses nationwide that have resulted in more than 2,200 arrests. This NYU student witnessed it.
It's chaotic. It was too much. It was aggressive. It was overly aggressive.
About 20 arrested. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are ripping higher. Equities wiping out the week's losses. The market getting a boost from Apple's post-earnings surge. Apple right now up 6.8% after last night's earnings report. Wall Street taking a slowdown in the jobs market as an indication that the Fed will be able to start cutting rates as early as September. Here's where we stand. S&P pushing higher, up 55 right now, up 1.1%. The Dow up 418 points, also up by 1.1%. The Nasdaq Composite Index up 300, a gain of just about 1.9%. 10-year at 4.50% with a 2-year 4.79%. Spot gold down $5.50 the ounce to $22.98, back below 2,300. A drop right now of just about 0.2%. West Texas Intermediate crude 78.50 a barrel, down 0.5%. Job growth moderated in April. And with that story, here's Bloomberg's Vinny Del Giudice.
Employers scaled back. April payrolls registered the smallest increase in 6 months, up 175,000. Unemployment edged higher to 3.9%, underscoring the moderation. Earnings moderated too, even with California's new law setting the minimum hourly wage for fast food workers at $20. Health, transport, and retailing accounted for most of April's job gains. Auto industry employment fell amid Tesla cuts. Vinny Del Giudice, Bloomberg Radio.
Oil stocks are trading lower, along with the price of oil. ExxonMobil, case in point, down 0.9%. ADRs of BP down by 0.6%. Chevron down 1.6%. Recapping, a Friday rally underway. Jobs Friday. S&P up 56, a gain there of 1.1%. I'm